Will come to order. The joint subcommittee hearing is titled Continued Oversight Over Regional Bank Failures. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. Without objection, the chair is authorized to declare a recess of the committee at any time. With that, I now recognize myself for 4 minutes. Today's hearing will help the Financial Services Committee learn more about recent bank failures, including management missteps, supervisory failures, and rapid-fire bank runs in the age of social media. I thank our witnesses for testifying today. The recent banking crisis was fueled by failed bank management, lack of hedges against interest rate risks, failed monetary policy, failed supervision, and overspending by the Biden administration and Democrats that led to historic inflation, prompting increased monetary policy action. Today, we will hear about what went wrong from the bank management themselves and state regulators. This is important as the committee is still waiting to get information from federal regulators about what happened. Information has been provided to the Government Accountability Office, but has not found its way from federal regulators and Treasury to this committee. Instead, individuals at the Fed, FDIC, and state regulators all decided to do their own self-assessments of the recent bank and supervisory failures and hastily put out public-facing narratives before independent assessments can be made. Today's hearing will help fill in some of the gaps that remain given the lack of transparency and accountability from federal regulators. To improve matters, I put forward 5 bills to increase transparency and accountability of federal regulators and their actions, especially when emergency measures are employed. We are not here to defend management at any of the banks that failed or to put anyone on trial for prosecution. In looking at the recent bank failures and the continued turbulence in our banking system, it is important to acknowledge that the bank failures did not occur in a macroeconomic vacuum. We have seen runaway inflation that was fueled by reckless, nearly $2 trillion American Rescue Plan in March of 2021, when personal saving economy-wide was already an astounding $5.7 trillion. Inflation continues to hammer American families, and the Federal Reserve was late to respond. Because the Federal Reserve failed to tighten monetary policy in a timely manner, interest rates were boosted at the fastest pace in modern history. That rapid monetary policy shock injected increased interest rate risks into the economy in general and banks' balance sheets in particular. Federal regulators and supervisors were again late in responding. They were late to even recognize that rapidly growing interest rate risk called for increased supervisory vigilance and prompt corrective attention to banks that faced the largest risks. Reading the hasty review of the regulators, banks that failed had mismanaged risks, were inattentive to risk management gaps that supervisors and examiners had identified, and sometimes were not adequately responsive or timely in taking necessary remediations. According to their narratives, regulators faced staffing issues and maybe could have been more forceful in working to get timelier remediations. Yet some possibly important issues are brushed aside by the regulators' reviews. Prior to the bank failures, there had been years of work from home and virtual rather than in-person bank examinations because of COVID restrictions. That fact, however, received only a few sentences in the Fed's report on SVB, identifying only the, quote, COVID-19 examination pause, unquote. A search of the FDIC review of Signature Bank for the word COVID provides one instance. It seems that such a factor and many others glossed over in the regulators' reviews deserve more scrutiny. Hastily produced reviews by regulators, coordinated for public release at around the same date, calls into question the extent to which narrative setting, rather than establishment of actual facts, was the motive for the reviews and public reports. Those reviews were led by individuals for the FDIC and Fed and not for the full boards, so they provide only one limited side of the story. I welcome the views and information that we will hear today, especially considering the lack of transparency and accountability from our federal regulators. I now recognize the chairman, the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois, Mr. Foster, for 5 minutes.
Thank you, Mr. Chair, and thank you to our witnesses for appearing here. My career in Congress and on this committee began in March of 2008, which was an interesting time to be a new member of the Financial Services Committee. We spent my first 3 years on this committee. First, I dealing with the emergency response to the financial crisis. Secondly, to identify the parts which were broken and the parts which weren't, and deciding what had to be repaired. And thirdly, with the regulatory response, the Dodd-Frank bill, that basically until a couple months ago had a pretty good record of preventing large-scale bank failures and financial crises. The financial crisis that we're dealing here is orders of magnitude smaller than what we dealt with in 2008, and we should keep that clearly in mind. But when a machine breaks, we have to identify whether it broke due to a design flaw or a manufacturing flaw. Did all the parts work as designed? Or was it simply subject to unanticipated conditions that are outside its design specifications and warranty? And so that's a lot of what this hearing is about. We have in front of us some of the key components in trying to keep a bank from failing, and we want to understand a little bit more about the details of what happened there. And so we also have to look at the changes that have been made externally to the banking system, having to do with the presence of the internet and communication. And if people are terrified now about the speed at which banking runs can happen, imagine what will happen in a few years where everyone is using their ChatGPT money manager, which will be programmed to pull your money out the moment a banking run is detected in our system. And how much capital and liquidity do you have to hold against that sort of environment? So the environment is changing, but our first step here is we have to understand if everyone played their roles as appropriate to the rules that were in place as of a few months ago and in the previous couple years. So I look forward to this hearing. Thank you. I yield back.
Gentleman yields. I now recognize the chairman of the Oversight and Investigation Subcommittee, Mr. Huizinga from Michigan, for 4 minutes.
Thank you, Mr. Barr, or Chairman Barr, I should say, and I'm glad that we were able to proceed with this joint subcommittee. I think this is important work that we do as we on these various subcommittees dig into the details and find out what is some of the most challenging issues that we've experienced economically here in the last couple of years. And I do want to say thank you to the witnesses for being here because this hearing from you is vital. It's vital as this committee continues its investigation into the recent failures of both Silicon Valley Bank and First Republic banks. And in testimony today, we're going to hear, I imagine, some try to pin these bank failures solely on bank mismanagement. Some will try to pin it solely on failed supervision. Some on unprecedented runs on deposits fueled by social media. I think the reality is, and I think everybody up here realizes, that it's a combination of all three of those things. Coupled with high interest rates, years of easy money, as the chairman was highlighting, and stimulus-fueled consumer spending, this administration and the Fed overheated our economy and then were late to pump the brakes, or to borrow that punch bowl analogy from Alan Greenspan. No one had the courage to take the punch bowl away from the party. So I'm sure some of my colleagues are ready to let you off the hook and maybe try to change the narrative. It should not be understated that the management of each of your banks is questionable at best. You were inept at managing both short and long-term risks. You courted deposits from risky businesses, took untenable financial risks, and ultimately failed to respond to rising interest rates. And Mr. Becker, your relationship with the San Francisco Fed should be scrutinized. At the time of its failure, SVB had 31 open supervisory failures or warnings from regulators, and yet nothing was done. It was not gone unnoticed that your position on the Fed's board of directors potentially created a relationship that impeded supervisors' judgment and created some of that leniency. And for their part, the Federal Reserve missed or ignored all of the signs, and when they did react, it was too late. Yesterday, in testimony before our committee, the Vice Chairman of Supervision, Mr. Barr, the other Mr. Barr, at the Federal Reserve, admitted that what we have all known for months. The failure of your banks was a result of failed supervision under his watch. He finally admitted that he had the responsibility of that. However, federal regulators will attempt to use these bank failures to exercise more and more authority well outside the bounds that Congress established for them, and the notion that these failures were a result of regulatory changes is unfounded. As we heard from the GAO, their reports about the Fed started in 1991, not 2155. It was 1991. Nevertheless, regulators will try to shift the blame, but the facts are clear. And in testimony before our O&I subcommittee last week, the GAO flagged those concerns in supervision and enforcement practice going back to 1991. The report concludes that all three federal financial regulators have, quote, wide discretion in choosing from among enforcement actions of varying severity, close quote. Lastly, an independent assessment of these events is not only appropriate, but it's desperately needed. This committee is committed to providing the American taxpayer with an unfiltered review of the events that preceded these bank collapses, and ultimately, they bear the cost of your failures. I look forward to hearing from each of you as we continue to seek these answers, and Mr. Chairman, I yield back the balance of my time.
The gentleman yields back. I now recognize the gentleman from Texas, ranking member of the Oversight and Investigation Subcommittee, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, holding this oversight hearing today with the former chief executives of Silicon Valley Bank and Signature Bank will allow important questions to be asked and answers to be received from those who nurtured the root cause of their bank's collapse. At yesterday's hearing, regulators acknowledged their shortcomings. Today's preeminent question is, will today's bankers acknowledge their faults? Will they take responsibility for the more than 70% uninsured deposits that alarmed depositors? Will they acknowledge both Silicon Valley Bank and Signature Bank experienced outsized growth between 2018 and 2022, and that Signature Bank grew from approximately $47 billion in total assets in 2018 to $110 billion in 2022? That Silicon Valley Bank increased from $56 billion to $209 billion over that same period of time? Will they admit that this outsized growth in assets was fueled by more than 70% uninsured deposits at both banks, far higher than the median of 32% for comparable banks? Will they confess that the executives at both banks knew or should have known that their risk management practices had to be strengthened appropriately as they grew in size exponentially? Will they concede that it was irresponsible for Silicon Valley Bank to operate without a chief risk officer from April until December 2022? Will they agree that those who nurtured the root cause of a bank's collapse should return any bonuses received as the collapse came to fruition? Will they allow and avow that upon Silicon Valley Bank having received 13 of the most serious supervisory warnings the Fed can issue, the bank's officers should have taken corrective action? And will they come clean about Signature Bank's failure to take corrective action after having received 9 matters requiring board attention notices from the Federal Deposit Insurance Corporation, including 3 specifically related to liquidity or risk management? Mr. Chairman, the time for atonement and recompense is at hand. Today provides us the opportunity to hear from those who had a hands-on experience with the failure of these banks. These persons were capable, competent, and qualified. They all have degrees indicating such, and they have experience connoting such. They should have taken corrective action. They will be given the opportunity to answer these questions that I've called to the attention of not only this committee, but also of this country. The people of America need to know what happened at these banks. This is the time for us to find out. I yield back the balance of my time.
The gentleman yields back. I now recognize the gentleman from North Carolina, the chairman of the full Committee on Financial Services, Mr. McHenry, for 2 minutes.
I want to thank Chairman Barr and Chairman Huizinga and the ranking members as well. At today's hearing, we'll hear 3 different stories from 3 different banks. Your business models were not the same. Your depositors were not the same. The degree of mismanagement was not the same in the midst of this crisis. The truth is, each of you bears responsibility as the captain of your respective ships. And we've heard that from you. There was a storm brewing, and you failed to batten down the hatches. And while inflation raged, the Fed and the Biden administration told us it was transitory, nothing to worry about. We'll get into the management question shortly, but one of the mistakes, though, is that these 3 bankers actually believed the bureaucrats. We all know inflation was not transitory, and after being late to respond, the Fed was forced to raise rates at the fastest pace in modern history. And again, you failed to appropriately prepare for this inflationary and high interest rate environment. Silicon Valley Bank was the projectile that set this volatility into motion. The Biden administration used another word to describe SVB, idiosyncratic. Well, clearly, as there are 3 of you today, 3 of the 30 largest banks in American history, in America today, the problem goes much deeper. The subsequent failures of Signature and First Republic, coupled with the volatility in regional bank stocks, sent shockwaves through our financial system. The fear of contagion has rocked an already shaky economy. So we'll hear from each of you today and the New York and California bank regulators as well. I think it's important to take a step back and really examine the undercurrents that caused this crisis. The economic mismanagement by the Biden administration that created the perfect storm that each of you failed to right your ship in. I yield back.
The gentleman yields back. Today we welcome the testimony of Mr. Greg Becker, former bank, and Mr. Michael Roffler, former CEO and President, First Republic Bank. We thank each of you for taking the time to be here. You will each be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Mr. Becker, you are now recognized for 5 minutes.
Chairs Barr and Huizinga, ranking members Foster and Green, and members of the subcommittee. Thank you for the opportunity to appear before you today. My name is Greg Becker, and I was the CEO of Silicon Valley Bank. I'm here today to answer your questions about what happened at SVB to the best of my memory. At the outset, I want to be clear that I never envisioned myself or SVB being in this situation. I was an employee for SVB for nearly 30 years and CEO for the last 12 years until it was taken over by the FDIC. I believed in the bank and its mission and cared deeply about our more than 8,000 employees and their families. I was committed to our clients and helping them succeed, whether they were well-known tech companies or small business founders in towns across the country. SVB was designed to meet the needs of the technology and life science industries where startups and later stage companies could keep their deposits, borrow to expand their businesses, and create jobs. We knew our clients personally, understood their needs and goals, and partnered with them as they grew. We took risk management seriously and worked closely with and were responsive to the various regulators who oversaw SVB. Over time, we built and expanded a team of subject matter experts focused on analyzing risks and protecting the bank, and continually sought to add operational expertise and experience to enhance our risk management as the bank and its clients evolved. Much has been said about the takeover of SVB by the FDIC and why it happened. Ultimately, I believe that SVB's failure was brought about by a series of unprecedented events. Between 2015 and 2019, SVB grew from about $45 billion in assets to $71 billion in assets at an annual rate of about 10%. This changed in 2020 due to the COVID-19 pandemic and the government stimulus measures. With near zero interest rates and the largest government-sponsored economic stimulus in history, more than $5 trillion flooded into commercial banks in the United States. By the end of 2020, SVB had grown 63% over the prior year, and in 2021, SVB's assets grew another 83% to $212 billion. To support this growth, SVB raised more than $8 billion of new capital in 2021. Importantly, throughout 2020 until late 2021, the messaging from the Federal Reserve was that interest rates would remain low and that the inflation that was starting to bubble up would only be transitory. During this time, SVB invested in low-risk, highly rated government-backed securities. These securities were safe assets, and they were backed by the U.S. government and could easily be used as collateral for borrowing for liquidity if we needed it. These fixed income securities complemented our short duration loan portfolio, approximately 90% of which had variable interest. Actively invested nearly $2.3 trillion of their securities portfolios in this low yield environment created by the Federal Reserve. To account for changing market conditions, namely higher interest rates anticipated over a longer period of time, on March 8th, we sold SVB's available for sale securities portfolio in a planned capital raise. Unexpectedly, on this same day, Silvergate Bank announced its intent to voluntarily wind down and liquidate, and depositors triggered a run on that bank. Despite stark differences in our business models, news reports and investors wrongly lumped SVB and Silvergate together. Rumors and misconceptions quickly spread online, culminating on March 9th with the first ever social media-driven bank run, leading to $42 billion in deposits being withdrawn from SVB in 10 hours, or roughly $1 million every second. Over 2 days, approximately 80% of total deposits were requested to be removed from SVB. To put the unprecedented velocity of this bank run in context, the previous largest bank run in U.S. history was $19 billion over 16 days. In the face of these unprecedented events, the leadership team and I made the best decisions we could with the facts and forecasts available to us at the time and in the best interest of SVB, its employees, and its clients. I worked at a place I truly loved, alongside our dedicated employees to support our clients who are innovating in astonishing ways. I believe that SVB had a positive impact on the roughly 100,000 clients.
The gentleman's time has expired. Mr. Shea, you are now recognized for 5 minutes.
Chairman Barr, Chairman Huizinga, Ranking Member Foster, Ranking Member Green, and members of the subcommittees. Thank you for the opportunity to be here today to discuss Signature Bank and my role as chairman of the board. In 2000, I co-founded Signature Bank. At the time, the banking industry was experiencing many mergers, and many big banks were not serving the needs of middle market customers. I felt that a mid-sized bank would provide an important commercial service to businesses that preferred a smaller, more personal experience. Signature Bank followed a single point of contact approach in which the bank's client teams personally served the needs of small and medium-sized businesses. Our bank had a diverse group of clients, including industrial companies, commercial real estate firms, healthcare providers, professional service firms, nonprofits, and many others. We placed a priority on providing financing to affordable housing providers in low and moderate income areas, and did so for many years. Through the hard work and dedication of our employees, we went from a small bank with $40 million of startup funds to a successful middle market bank with more than $100 billion in deposits. We were a solid and thriving bank that played an enormous and important role in our clients' businesses, and I was very proud of our success. In 2018, we began accepting deposits from businesses in the digital asset sector. I supported this effort because I believe that digital asset payment systems can make financial transactions faster, easier, and cheaper. with funds moving from place to place in minutes rather than hours or days, and at a much lower cost than traditional payment systems. I was not alone in my enthusiasm for digital assets. Over the years, many other banks, many financial institutions, and others have entered the market for digital assets, and governments, both state and federal, have expressed support as well. As with other parts of Signature Bank's business, digital deposits grew over time. Nonetheless, because this was a relatively new sector, Signature Bank carefully monitored the business in an effort to ensure that clients met our internal standards, including for compliance with anti-money laundering laws. We also limited the kinds of businesses that we would do. Signature Bank's digital asset business was focused on accepting U.S. dollar deposits from businesses in this sector. Additionally, I publicly supported increased government regulation of the digital asset sector in order to ensure that businesses operating within the sector had regulatory oversight. In the latter part of 2022, the digital asset sector experienced increased volatility and regulators expressed concern. Signature Bank took these developments seriously and in just a few months significantly reduced its digital asset deposits. Unfortunately, a series of truly extraordinary and unprecedented events unfolded quickly. On March 7th, the bank with strong ties to the digital asset sector announced it was going out of business, and 3 days later, on March 2nd, a second bank was closed by the regulators. And then, within just a few hours, our depositors withdrew $16 billion from the bank. Nonetheless, I was confident that Signature Bank could withstand the economic earthquake that occurred that day. The bank was well capitalized. The bank was solvent. Indeed, it was always solvent, with assets well in excess of liabilities even at the very end. And the bank had a well-defined and solid plan to continue in operation and withstand additional withdrawals. Although I believe that the bank was in a strong position to weather the storm, regulators evidently saw things differently. On Sunday, March 12th, regulators seized Signature Bank. Although I disagreed with this decision, I recognize the important role the bank regulators play in our financial system. My first priority in helping to build Signature Bank was providing excellent service to our customers. I was therefore pleased that the government guaranteed the full amount of customers' deposits. Helping build a bank that for 22 years played an important role in the middle market sector of our economy was the pinnacle of my professional life. For that reason, March 12, 2023 was a devastating day for me.
Gentleman yields back. Mr. Roffler, you are now recognized for 5 minutes.
Thank you. Chairman McHenry, Ranking Member Waters, Chairman Barr, Chairman Huizenga, Ranking Member Foster, Ranking Member Green, and members of the subcommittees. Good morning, and thank you for allowing me to speak with you today. Since 2009, I have had the privilege of serving First Republic Bank and its employees, clients, and communities. I look forward to sharing with you a little about First Republic, our reputation for risk management and integrity, as well as our understanding of the unprecedented banking crisis that affected us beginning on March 10th. I would like to start by thanking my incredible colleagues who have worked tirelessly since March 10th, continuing to serve our clients and delivering outstanding service in the face of unprecedented challenges. For the past 37 years, First Republic has built a reputation for its commitment to extraordinary client service, careful risk management, robust internal controls, and transparency with our regulators and the public. First Republic's financial position and strategy were regularly reviewed by our regulators, the California DFPI and the FDIC. First Republic's management and board of directors took regulatory feedback extremely seriously and addressed any matters in a timely manner. Neither regulator expressed concern regarding First Republic's strategy, liquidity, or management performance, just the opposite. Up until the cataclysmic events of March 10th and the following days, which were triggered by the collapses of Silicon Valley Bank and Signature Bank, First Republic was in a strong financial position with strong investment-grade ratings aligned with the nation's largest banks. In fact, Thanks to our employees' extraordinary efforts, First Republic had its most profitable year ever in 2022. Starting in the fall of 2022, First Republic believed that the Federal Reserve's campaign to fight inflation by repeatedly and significantly raising interest rates would make 2023 a more challenging year from an earnings perspective. First Republic was transparent about the challenges posed by this higher interest rate environment. No one at First Republic could have predicted the collapse of Silicon Valley and Signature, the speed at which it happened, or the impact it had on the banking industry. Instead of dealing with temporary decreased earnings due to interest rate pressures, First Republic was contaminated overnight by the contagion that spread from the unprecedented failures of those banks. Before March 10th, First Republic was conducting business as usual. Indeed, during the day on March 9th, as uncertainty surrounding Silicon Valley grew, we experienced a significant inflow of deposits at First Republic from clients who had withdrawn their money from Silicon Valley. Everything changed overnight. On the morning of March 10th, when Silicon Valley collapsed, a run on First Republic began. In response to an industry-wide pandemic about the soundness of regional banks, industry-wide panic about the soundness of regional banks, which was exacerbated by traditional media and social media, over the course of the ensuing weeks, over $100 billion in deposits were withdrawn from the bank. Despite Herculean efforts by my incredible colleagues at First Republic to continue providing exceptional client service, management's tireless efforts to save the bank, and the support of 11 of the nation's largest banks, investor and depositor confidence never recovered. Throughout this period, I encouraged colleagues to be there for and to serve the needs of our clients. But clients continued to withdraw their funds, and to protect our clients and depositors, the FDIC reached a purchase and assumption agreement with JPMorgan Chase to assume all of the deposits and substantially all of the assets of First Republic. We continue to work hard every day to ensure our clients receive the service they deserve. I look forward to working with the committee to restore confidence in the banking industry, and I would be pleased to answer your questions.
I thank the witnesses for their testimony. We'll now turn to member questions, and I'll recognize myself for 5 minutes. Let me start by following up on a line of questioning that I asked Vice Chairman Barr yesterday. And I asked Mr. Barr if the delay in monetary policy normalization in light of persistent and high inflation, I asked him if gradually tightening monetary policy versus precipitously raising rates would have made it easier for the Fed to supervise and banks to manage interest rate risks. He declined to acknowledge that monetary policy failures by the Fed were the underlying cause of the current instability in the system. While I do agree that it is the responsibility of bank management to manage interest rate risks, I believe we should also acknowledge that the Fed's unprecedented and protracted easy money policies, quantitative easing and keeping interest rates too low for too long, necessitated an historically rapid and precipitous increase in interest rates, 500 basis points in just 13 months, leading to a blunt and difficult interest rate environment for institutions to adjust to. Mr. Becker, did bank supervisors at the Federal Reserve of San Francisco show any extra attention to interest rate risk issues? And if they did, when did they begin to show that attention?
Chairman Barr, to my memory, the rapid rise in interest rates were going back to 21, that topic coming up. I don't remember that coming up to the best of my recollection.
So you're telling me that as the San Francisco Fed, 20 bank examiners in your bank every day, not once in the last year do you remember any of those bank examiners discussing interest rate sensitivity with you?
With me, my memory is no. It could have happened with our Treasury team or our CFO, but I don't remember having a direct conversation about that.
Mr. Becker, Silicon Valley Bank did not have a chief risk officer 8 months leading up to its failure. Clearly, there were major interest rate risks that obviously were not being discussed by the bank regulators with you all. But it's safe to say that a chief risk officer would have been a useful addition to the management team. What were your conversations with the Fed on this issue, and did they voice any concerns with the vacancy or request that you take action to fill the position? And if so, how did you respond?
Chairman, as I outlined in my written testimony, towards the end of 21 and the beginning of 22, our board of directors and the regulators, the Federal Reserve, were giving us comments about the need to enhance our chief risk officer position, especially as we started to approach $250 billion of assets. We took that feedback very strongly, and we decided to make a change. So we did two things, knowing that it takes, quite honestly, a while to find the best candidate for a role. In my assessment, it takes 6 to 9 months to find an executive of the caliber that you would want. We did two things to make sure we didn't have gaps during that period of time, of which both of those things were noticed and, before we made the change, communicated to the Federal Reserve. First, we created an office of the Chief Risk Officer. It was a leadership team of the risk team, along with new hires with LFI experience. Those individuals reported to me, and they also reported to the chair of our risk committee. The second thing we did, we kept our existing Chief Risk Officer on board as a consultant from April until October 1. Our new Chief Risk Officer started or was hired October, and then she started in December.
Did the Fed express any concern that despite standing up an office that there was not a position filled?
They did not.
Okay, Mr. Roffler, it's our understanding that prior to entering receivership, you had viewed all options on the table, including the sale of your bank. Can you describe the difficulties you faced in finding a potential acquirer? If you could turn on your mic.
My apology. Thank you, Mr. Chairman. Yes, following the events of March 12th and 10th and shortly thereafter, we worked with our legal counsel and our independent advisors to look at all options on the table, including potential merger, potential sales of assets.
Did the FDIC begin to gather and distribute data about your bank to potential acquirers prior to the week of April 24th?
Not to my knowledge.
Mr. Becker, FDIC Vice Chairman Travis Sill recently stated that the FDIC could have moved more quickly in finding a buyer for Silicon Valley Bank, saving the hit to the diff, if they had shown some more urgency in setting up data rooms. Can you explain your perspective on how this process worked and whether the FDIC could have done better?
So again, this happened very fast. And so on March 9th, which is really the first day that the bank run started, the FDIC got involved. And then they took over on the 10th. We immediately worked with them and worked as fast as we could to build a data room with the list of information they were looking for.
But my time has expired. Obviously, it was not fast enough. I now recognize the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, Mr. Foster, for 5 minutes.
Thank you, Mr. Chair. Mr. Becker, I accept what you said, that you never envisaged the situation that Silicon Valley Bank had come into. But my focus here is what rules could have been in place that would have changed your behavior. I imagine you spent a lot of the last few weeks thinking about what you should have done if you had perfect knowledge ahead of time. And high on my list are simply hedging your interest rate risk instead of apparently removing some interest rate hedges, and also raising capital last summer when you still could. Are there other major things that you wish you had the foresight to have done?
Congressman, maybe just to comment on your one point about capital raising. Our capital ratios, even up until March 10th, were actually very strong.
I understand, but one of the rules changes we can contemplate is to make you immediately recognize some fraction of your mark-to-market losses on securities. All right, and so one of my follow-on questions here, which you can try answering now, let's say that you had immediately had to recognize 100% of your actual mark-to-market losses. Would that have affected your behavior materially?
Congressman, the mark-to-market is in two categories. One is your available for sale portfolio, and then your held to maturity.
Right, just say all of it, just to take an extreme case, all of it.
Yes, if everything, both available for sale and held to maturity, was mark-to-market, yes, we would have had to raise more capital.
And then what happened early, last summer probably when interest rates started going up?
Yes,
And that would have,
when the mark-to-market occurred, correct.
yeah, and in all probability, you would be solvent today if that had been the rule. Now, there are many, I'm not saying that should be the rule, but there's a knob that we can adjust, which is what fraction of the mark-to-market losses should be immediately reflected.
Congressman, as I mentioned in my testimony, I believe this was unprecedented events. At the end, it was fueled by the fastest bank run in history, and I don't believe, my opinion, even with additional capital, if that were to occur, I don't think we could, or possibly any bank could have lived with that amount of deposit outflow in that short a period of time.
Yeah, well, there are many issues there. No, there were also governance issues which have been, so if some fraction of the regulatory findings would automatically have been made public, particularly the governance ones, one of the things that make this hard for us in Congress to deal with is that a lot of regulatory actions have to take place in secret. But if there was some fraction of things, for example, governance, that would automatically become public, would that have sort of lit a fire under you to maybe act more quickly on the risk gaps and so on?
Congressman, when the first discussion that I recall having with the regulators on governance, questions of governance, was in January of 22. And as soon as those conversations were had, we immediately reacted to that feedback. We didn't wait until the May 22nd or the May 22 letter. We immediately reacted to it and put together a whole series of programs and processes to make the improvements that were requested. So I don't believe that even if
you don't believe the threat of making them
work.
public would have accelerated that at all? Okay. So now, if during the period of your rapid growth, you had been forced to issue a contingent convertible debt, COCOs, as Asian banks and European banks are forced to, this would have forced a conversation with the bond market as to the risk position of your bank. And it also would have provided a capital buffer that you would have access to when you got in serious trouble. Would this have materially changed your behavior or the result? You can answer that. It's a complicated question. If you want to answer that in writing for the record, I'd appreciate it, because that's one of the things that I think both Chair McHenry and I think may be part of the solution here to make a more stable banking system. And I'd be interested in your thoughtful opinion on that.
Congressman, as mentioned in my written testimony, I don't have access to my information from the bank, and so I would do my best with the information that I have to be able to answer your
fair
question.
Enough. Yeah, fair enough. This will not be an exact calculation of what would have happened, but I'd be interested in your opinion. Mr. Shea, it seems like the most significant factor in signatures demise was not so much a concentration in crypto assets or deposits, but a lack of pledgeable assets immediately available for liquidity support. Are there changes in procedures or rules to make that more agile that you'd advocate?
I don't know the answer to that question. I do know that when we opened at the beginning of March 10th, we had $29 billion of pledgeable assets that were at the Federal Home Bank and the Federal Reserve. And in terms of the ease of moving those assets, that was something that could be looked at in terms of making that.
We're gonna have to move on. The gentleman's time has expired. I now recognize the chairman of the subcommittee on oversight and investigations, Mr. Huizenga, for 5 minutes.
Thank you, Chairman Barr. Appreciate the witnesses being here and your candor. I'm going to ask you what I think are kind of two of the most important questions, frankly, and I'm going to go down the line asking you this. First is whether you take responsibility for the failure of your bank. Mr. Becker.
Congressman, as CEO, I think you have to take responsibility for the ultimate outcome of your institution.
Okay, appreciate that, Mr. Shea.
As chairman of the board, I think I did a responsible role throughout and fulfilled my duties.
Mr. Chairman,
Just,
this,
just a second. Is that, do you accept the responsibility for the failure, or do you believe it was other
very
management
sorry.
people?
I'm sorry that the bank was, seized by the regulators. I thought we had a responsible
depositors
plan
are
open
too.
the next morning.
Okay, so I take that as a no. Mr. Roffler?
Mr. Chairman, this was an event that is unforeseeable when it happens, and the contagion spread very quickly, and panic is very hard to control. What I feel responsible for is for our colleagues each and every day and our clients each and every day to make sure they're taken care of and supported during this time.
So that also sounds like a no. So congratulations, Mr. Becker. You're the only one to man up and actually take responsibility for that. I'll start with you. And since I can't get the other two to actually admit to their own failings, I'd like to hear from you. What would you have done differently in hindsight?
Congressman, that question to the point made earlier by Congressman Foster, I've thought about that a lot over the last several months. And when you look back at, and with hindsight, what could have been done differently, I think it's very challenging, because when you go back and make decisions, you have to go back and look at the facts that you had. And what I tried to describe in my written testimony is the facts that we had, that I had when I made my decisions, and I believe my team had when they made their decisions. And I truly do believe they made the best decisions, as did I, with the information that we had.
We're gonna explore that a little more, because yesterday you testified that SVB's capital and liquidity were validated by regulators in 2022. Your written statement points to an August 2022 letter sent by the regulators that conveyed the second highest possible CAMELS ratings of a 2, meaning satisfactory, on liquidity, capital, and market risks. Despite a downgrade of the liquidity rating in August, when you received the supervisory letter, were these ratings cause for alarm, or did you seem to confirm that you were on track? And then I also want to address something that you had said to Chairman Barr. You said that the Fed did not talk to you about the interest rate risk. They had 31 matters requiring attention, but none of them were about interest rate risk? Talk to me about that.
Yeah, Congressman, again, I'm going based on the best of my recollection.
Yep, understand.
I don't recall a direct conversation about that. I know that in, I believe towards the end of 22, there was a matter requiring attention on interest rate risk that was issued. I was not in that meeting.
You said late 2022.
I believe that was in late 22.
All right. So until that time, just as you had confirmed, I'm confirming what you were saying to Chairman Barr, this was not an issue for the regulators.
Congressman, again, to the best of my recollection,
understand.
I don't recall.
Okay. Well, you had a memorandum of understanding to target matters requiring immediate attention. What were the major issues of that MOU to your knowledge, your recollection?
Yeah, Congressman, if I could clarify one point.
Yep.
The memorandum of understanding was never issued. It was verbalized to us, and it was verbalized us to in early 2022.
That doesn't really sound like a memorandum. It sounds like a conversation of understanding. Okay. All right. So did regulators follow up with you on the status of this MOU conversation, or ask for your timeline, or give you a timeline?
As I mentioned earlier, we were incredibly responsive to the feedback that we received at...
Real quickly, we've got 30 seconds. You testified yesterday that you offered several times to the FDIC to, quote, engage potential acquirers and run through a list of the names who you believed would be most likely acquirers. And every single banker I've ever talked to, big, small, or medium, has always had some conversations with competitors who might become allies. You stated that you offered your assistance, but the FDIC never consulted you in this. Can you confirm that, and why do you think they didn't? And did they give you any indication why they had no interest in your opinion on this?
Congressman, I can confirm that they did not engage me in reviewing a list or talking about any potential acquirers.
Sad. I yield back.
Gentleman's time has expired. I now recognize the ranking member of the Oversight and Investigation Subcommittee, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. Chief Executive Officer Becker of Silicon Valley Bank. Were you a board member of the Federal Reserve Bank of San Francisco?
I was.
Educated well in banking? Were you educated well in banking?
I've been in banking my entire career.
Yes. The Republicans, my colleagues, whom I love dearly, they seem to believe that failure to sufficiently punish you is a cause of the bank's failure. They've been alluding to this for days now. In fact, perhaps even weeks or more. Are you contending that because the regulators didn't punish you properly, your bank failed? That would be a yes or no, sir.
Congressman, we were
Sir,
very...
that would be a yes or no. Are you contending that the failure of regulators to punish you properly is a cause of the failure of your bank?
Congressman, we were
That would be a
responsive.
yes or no, sir. Would you contend that the failure, sir, of regulators to punish you is a cause of your bank's failure?
Congressman, we were responsive to the regulators.
The question is not whether you were responsive, sir. Please. Are you blaming the regulators for not punishing you? So if they had punished you, is what you're saying now, you would have done better. Is that what we'd understand? A man who was sat on the Federal Reserve Board, highly educated, is that what we're to understand?
Congressman, as I articulated in my written testimony, there was a series of unprecedented events that all came together.
But I'm not, that's not the question. You see, you are eschewing the answer. And the question, I might add. The question is about you, your experience, and whether you're now going to blame a lack of punishment. You don't want to differ with them. They coddle you, I understand it. But this is a time for truth. You ought to speak truth, sir. You know that the failure of regulators to punish you is not the reason your bank failed.
Congressman, I believe the regulators, as the SVB management team, did the best they could with the information
Thank you.
that they had.
That's sufficient. I appreciate your saying that. Because for too long now, my colleagues have contended that it's the regulators who are at fault here. The regulators are not at fault. They have some things that they could have done, perhaps, and should have done. But at the end of the day, according to the Government Accountability Office, and according to the regulators who were here yesterday, the bank's failure lies with the banks at the end of the day. Now let me ask you another question, and this will apply to all three of you. Just raise your hand, because I can't ask you individually, I don't have enough time. Any of you conferred with the president about risk management and banking? If so, raise your hand. Any of you? President Biden. There's a reason for the question. Let the record reflect that no one has raised a hand. The contention from my colleagues is that this is all President Biden's fault. Because of President Biden, you somehow made mistakes in your risk management practices. You didn't talk to President Biden. You don't base your decisions on news reports about interest rates that you can't validate, or at least have your risk management people give you some confirmation of. Any of you think President Biden caused you to make the decisions you made? If so, raise your hand. Let the record reflect that none of the witnesses has raised a hand. Finally, this. Do you think that the bonuses received, Mr. Becker, Chief Executive Officer, should be returned? The bonuses received at or near the time of the collapse of the bank should be returned.
Congressman,
That would be a yes or no. The
expect to
chair is ready to
cooperate
sound
with
the hammer.
process that's going to be given.
Yes, but do you think they should be returned?
Congressman, I will cooperate with the process that I know will be.
Well, we're going to have some clawback legislation for you to cooperate with. I yield back.
The gentleman's time has expired. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you very much, Chairman Barr. We heard an exchange a while ago from a member on the other side said when he got here in 2008, he was reminiscing some of the circumstances. They weren't very pretty. But one thing that was resolved by the party in charge at that time to make sure that we never had another bank failure or an economic crisis, they established the CFPB, the Consumer Financial Protection Bureau. And among its charges was to make sure we never had any more bank failures. And I'm just wondering, did you have any contact with the CFPB, Mr. Becker?
The CFPB was one of our regulators, but given that we were predominantly a commercial bank, the interaction with the CFPB wasn't as significant as the other regulators.
It was less significant than with the other regulators, did I hear that correct?
Than the Federal Reserve and the state and the FDIC.
Okay. Mr. Shea, same question.
In my role as chairman, I don't recall ever meeting anyone from the CFPB.
Okay. Mr. Roffler, same question.
I don't believe I've met with anyone from the CFPB, but they did periodic exams and visits to First Republic.
Okay. Do you think the CFPB, Mr. Roffler, could have been more helpful in helping you avoid?
I think that the CFPB, along with our other regulators we interacted with, we ensured we had a very professional and open relationship. We shared with them what the bank was up to and what the strategy was and how our results were. And they did thorough examinations and we responded to any feedback.
Okay. Mr. Becker, did you sell, convert, or otherwise affect any of your stock in the 12 months preceding?
I sold, there was no stock that was sold in 2022.
A little bit into the mic, I can't hear you well.
Yeah, there was no stock. I didn't sell any stock in 2022. And in 23, I sold after our earnings release, after it was reviewed by our legal team and myself, that I didn't have inside information. We put a 10b5-1 plan in place in January, and that was sold with expiring stock options from 2016.
How much was that, the value at the time of that, probably?
The gross amount was $3.6 million.
Okay. Mr. Shea, same question.
I sold no shares I sold no shares in 2022, with the exception of reversing 3 shares that were accidentally bought in my account, which were then sold back. Those were 3 shares. And indeed, I purchased shares throughout that period.
2023?
2023, I purchased shares on March 10th, 2023.
Okay. Mr. Hoffman?
I transacted twice, once in 2022 and once in early 2023. Both of those transactions were made with the approval of our policy and procedure and our general counsel, and they were also made following disclosure of financial information to the market, 1, through our investor day, and number 2, through our earnings release. And the last thing I would say is that it represented a portion of my shares, and the vast majority I retained.
Yeah. What were the dates and amounts of those transactions?
One of the dates was about November 15th or 16th, and it was just over $1 million. And the other date was around January 19th or 20th, roughly the same amount.
Okay. I see my time is about to expire, Mr. Chairman. I yield back.
Gentleman yields. Gentleman from California, Mr. Sherman, is now recognized.
Thank you. One thing I've commented on is the idea that the Federal Reserve regional boards are not all selected through democracy and the voters of this country, but governmental power is given to those who are elected by banks. And they elected Greg Becker. I'm not so sure it's a good system. We ought to have all governmental power in this country in the hands of the executive, judicial, or legislative branches of government. One bank, one vote is not democracy. After hearing the near tearful presentations by these CEOs of their dedication to their customers and employees, I guess they want us to say thank you for your service. Can't say that. My Republican colleagues are in this desperate effort to defend corporate malfeasance with their old strategy of blame Biden. The fact, what they've suggested is that we shouldn't have fought inflation and Americans should be paying higher prices. We should have managed all monetary policy so that the three worst run banks in America would survive. Talk about the tail wagging the dog. This was not a 100-year flood. We saw 16% interest rates under the Reagan administration. I didn't say the Harding administration, the Reagan administration. This was a modest rainstorm, and three of you went down. 99.5% of the banks survived this modest storm. The reason these banks went down is because recklessness and greed. The bigger the bonus, the bigger the risk, the bigger the bonus. And I'll illustrate that in a bit. We shouldn't be blaming the depositors. The depositors didn't take their money out of profitable banks. They didn't take their money out of solvent banks. This is not just a liquidity problem. The strongest bankers in this country looked at Silicon Valley Bank and determined that it was worth negative $20 billion. If anyone has their money in a bank where the net worth is under is a negative $20 billion, it's time to get your money out of that bank. Let's talk about, okay, so Silicon Valley Bank virtually doubled the duration and therefore increased the yield of the securities that it held. That led to bigger risk, higher profits, and more money in Mr. Becker's bonus for the 2022 fiscal year. Then Silicon Valley Bank at the end of 2021 had 56% of its available for sale portfolio hedged through credit default swaps. In other words, they had insurance on this 56%. They saved money, cut the insurance down to insuring only 2% of the portfolio, lower costs, higher profits, bigger bonus. So it's not surprising that these are the banks that went down. Mr. Becker, you've said you take responsibility for the collapse of your bank. Are you willing to return the bonus that you got the day before the bank failed and that you then took on your Hawaiian vacation?
Congressman, as I said earlier, I plan to cooperate with the process.
Will you do it voluntarily or only if the government forces you to?
Congressman, I will cooperate with the
process. That means only if the government forces you to. Will you voluntarily return that portion of the bonus directly attributable to the bank's higher income for 2022 because you went to longer-term, higher yield securities?
Congressman, I will cooperate.
In other words, only if forced. And will you return that portion of the bonus attributable to the money you saved by throwing away your flood insurance as it began to rain or cashing it in and not having hedges and credit default swaps on your portfolio? You return that part of the bonus?
Again,
not voluntarily.
Cooperate with the process.
Mr. Becker, you testified before Congress in 2015 that having tough regulation would divert significant resources of the bank to complying with enhanced prudential standards and other requirements. So we have less regulation of your bank. How'd that work out for you?
The gentleman can submit his answer in writing. The gentleman's time has expired. The gentleman from Missouri, Mr. Luchtenmeyer, the chairman of the National Security Subcommittee, is now recognized.
Thank you, Mr. Chairman. Welcome to the guests this morning. Gentlemen, as tragic as the situation is, I think it's also a learning moment for all of us, an instructive moment, I think, for us in Congress and for the regulators and for bankers around the country, quite frankly. From the standpoint that I think we're in a new world now with regards to social media and the actions that can be taken, the actions that can have adverse effect on our financial system, our culture, our economy, and I'm very concerned about it. Each of you in your testimony mentioned that Mr. Becker, $42 billion went out your bank in 10 hours. Mr. Shea, $16 billion went out in just a few hours. And Mr. Roth, I missed the number on yours, but again, you had the same situation where social media excited people to the point where they ran out, changed their banking situation, and as a result, a lot of the uninsured deposits in your bank ran out. I would like for you to give me your analysis on this. Was the FDIC tracking this with you as this was happening so that they were aware of this, or were you notifying them at all as this money was running out the door? Mr. Becker?
Yeah, Congressman, is it, we notified the regulators that we were doing the capital raise, so they were aware of that. And when the bank run started on March 9th, I was not directly involved, so I can't say the exact discussions that were happening, but to my memory, to my knowledge, our risk team and our regulatory affairs team were engaged in conversations with the regulators.
Mr. Shea?
As chairman, I don't know precisely I don't know the conversations that were taking place between Treasury.
Was there contact, I guess, is the question.
Excuse me?
Was there contact between your bank and the regulators with regards to the amount of money that was flowing out?
I would defer to management. I don't know the...
Mr. Rothler?
Thank you, Congressman, for the question. As I mentioned in my testimony, we always had an open working relationship with the regulators. That included, as the contagion spread on March 10th, we had multiple meetings in the morning all the way through the evening that day, reviewing our funding and our liquidity and what was happening at the bank.
All of you having gone through this, what do you think is a realistic situation that we need to be considering here? And I sit on the China Select Committee, and this scares the dickens out of me, quite frankly, because I'm sure the Chinese are watching us play funny business with our own banks and our own economy. Do you think, having gone through this is a very real concern, or am I overreacting to this? The short selling is going on right now, not to the extent it was, but can social media have the kind of effect on this that could actually directly impact or could crash our system? What do you think, Mr. Becker?
I think we are evidence of that, and I think it's something that needs to be looked into to determine how best to protect against it.
Mr. Shea.
Thinking back to that Friday, those few hours, and I remember talking to depositors who were so panicked. I started my career, I was on Wall Street during 1987. The panic that was flooding through social media, people were saying they didn't want to hear about solvency, that the bank was solvent. They didn't want to hear about $29 billion of liquidity. They didn't want to hear about rating agencies, ratings. They didn't want to hear about anything. They just wanted to hear they had to get their money to a too big to fail bank, and they needed to do it immediately.
Mr. Offler.
Yes, Mr. Congressman, it's very challenging, and the panic was very real. And as I spoke with clients too, at the end of every conversation, if they decided they wanted to do something different, we facilitated that and helped them. But it definitely was started with the contagion that spread to us from the activities the day before.
This really concerns me, because I think, back in 2020, we had a run on toilet paper of all things. And I think people will prioritize their money over toilet paper. So we already have 3 examples here. And I think the regulators took some actions to minimize this contagion effect across the system. Whether it was enough or not in time, I'm not sure. But I think it's something we need to certainly look at and study. Vice Chairman Barr was here yesterday, and he made the comment that the core responsibility of examiners is to look at interest rate risk and liquidity risk. Mr. Becker, were the examiners looking at credit, interest rate risk and liquidity risk in your bank?
Congressman, liquidity risk, I know for certainty that was discussed, and I don't, again, as I mentioned earlier, to answer your question, I don't have direct experience in hearing about interest rate risk, but I'm confident it happened.
Okay, thank you very much.
Gentleman's time has expired. The gentleman from Georgia, Mr. Scott, is recognized.
Mr. Becker, over here, what percentage of your deposits at Silicon Valley exceeded the FDIC's insurance cap just before the bank collapsed on March 10th of this year?
Congressman, as I mentioned in my testimony, I've been at SVB for 30 years, and to my recollection, we've always had a high level of uninsured deposits. It was not that different at the end versus what it was a year earlier.
I'm sure that the whole nation, the whole world knows you had a high percentage. But, in fact, according to the S&P Global Market Intelligence data from December 2022, we now know that Silicon Valley Bank ranked first among banks with more than $50 billion in assets, with 95% of its total deposit being uninsured. That's the truth. And for you not to know that, for you not to answer that, is absolutely unbelievable. While the average for U.S. banks was 30%, you had 95%, almost all of your accounts, uninsured, according to the S&P's Global Market Intelligence. Not only exceeding the FDIC's insurance cap, but doing so with this 95% in high concentrations in the technology sector, making your bank highly susceptible to panic. I think you're going to go down in history as absolutely being the most irresponsible leader of a bank in the history of this country. To have 95%, almost all of your accounts uninsured. So not only were you exceeding the FDIC's insurance cap, but with this technology sector, making your bank highly unsusceptible to panic. So let me ask you this, Mr. Becker. At any point leading up to March 10th, were you made aware of regulators' concerns regarding your bank's over-reliance on 95% of your bank accounts being uninsured deposits?
Congressman, to my earlier point, given we're a commercial bank, we've always had a high level of uninsured deposits. And to my memory,
a high level, you keep saying a high level, all of them. Even, I can't even imagine you're thinking at that. And you're thinking the American people are not highly disappointed in your total disregard of their money in your hands, and you're not having it insured. Less than 5% insured. Now, let me ask you this. Who made the decision to maintain this reliance on uninsured deposits, given the warnings? Also, by our federal regulators. Who made this decision, Mr. Becker? This foolish, irresponsible, and deceitful decision. Who made it?
Congressman, as I said, that's been our business model for as long
Who
as I can
made the
remember.
decision, my friend?
And that information.
Was it you?
The gentleman's time has expired. He can submit an answer in writing for the record. The gentlewoman from Missouri, Ms. Wagner, the chair of the Subcommittee on Capital Markets, is now recognized.
I thank you, Mr. Chairman, and I want to thank our witnesses for appearing before the committee today. The reckless actions by you and your management put the paychecks of millions of Americans and thousands of businesses, some of which were in my district, Missouri's 2nd Congressional District, at great risk. The week SVB failed, I had businesses that provide good jobs in my district left wondering if they would be able to even make payroll the following week. Now, yesterday, we discussed the supervisory failures, abject failures of the prudential regulators. It's now abundantly clear that they should have taken stronger enforcement actions after many, many citations, MRAs, MRIAs, to prevent these collapses from happening. Today, I want to hear from you all as to why your banks were insufficient in addressing a rising interest rate environment that started over 12 months ago. Mr. Becker, as interest rates increased at the most rapid pace in modern history because monetary policy had to battle runaway inflation, did supervisors at the Fed show extra attention to interest rate risk issues? And if they did, when did they begin to show that attention?
Congresswoman, as I mentioned earlier, when I look at the supervisory findings, we had one MRA regarding interest rate risk, and it was mainly related to modeling. To my memory, I don't recall that coming up as a major topic. What was the discussion that had been had, the main one was around liquidity. And we, to my knowledge, addressed all or the majority of those findings during 2022.
Mr. Becker, by March 8th, 2023, when SVB announced that it was selling the available for sale portion of its securities portfolio, the Fed had already implemented 9 interest rate hikes. Why didn't SVB attempt to sell these securities sooner?
Congressman, the decisions around when to sell the securities and what to do is monitored and managed by our Asset Liability Committee and our Treasury team and overseen by our Finance Committee of the board. The first time that I recall coming up about the possibility of selling our available for sale portfolio was in the fall of, or towards the end of 22, and it was decided that at that point it didn't make the most sense. There was a belief that the rapid rise in interest rates could create and likely would create a recessionary environment, and rates would actually start to go the other way. In the beginning of 2022 or 23, we realized that that was unlikely to happen, and we decided to then sell the portfolio.
Okay, Mr. Becker, the Fed report notes that prior to 2022, Silicon Valley Bank had interest rate risk hedges on some or all of its longer dated maturities. The Fed report further notes that over the course of 2022, the bank pursued a strategy of dropping those hedges. Can you explain why you made the decision to drop these hedges?
Congresswoman, 2 points, and I'll get to the answer to your question. The hedges that were in place, again, set up by our Asset Liability Committee and our Treasury team, were only on a portion of our available for sale portfolio, which was a much, much smaller portion of the securities portfolio. So I don't recall the specific percentage, but it was actually a small percentage of the overall portfolio. As far as the decision to sell the hedges, that decision was made by our Treasury team and our Asset Liability Committee.
Wouldn't it have been more beneficial to your balance sheet to have kept those hedges as long as additional interest rate hikes were on the horizon? I mean, if the Fed was clearly going to keep raising interest rates.
Congresswoman, I don't know the exact rationale behind it. I don't have that information.
Such poor mismanagement. So reckless. There's so many paychecks, 2 million that were on the line, many of which in my own district. I'm just disgusted. Following up to Mr. Huizenga, I'd like you to answer this in writing. We were talking about your engagement with the FDIC of a potential acquirers. You said that they did not engage you. I want to know if you were surprised that the FDIC did not take you up on that offer, and if you knew how many acquired, but you can send that to me in writing. Thank you. I yield back.
Gentlelady yields back. The gentleman from Massachusetts, Mr. Lynch, is recognized.
Thank you, Mr. Chairman. I want to follow up on the gentlelady's line of questioning. Mr. Chairman, I'd like unanimous consent to enter into the record an article from the New York Times dated December 15, 2021.
Without objection.
So this article basically says that the Fed had made clear, this is December of 2021, Mr. Becker, and it says that a fresh set of economic projections released on Wednesday showed that Fed officials expect to raise interest rates, which are now set near zero, 3 times in the following year. So this is December. This is December of 2021. The Fed went ahead and raised rates 7 times in the following year, but said they were going to raise them 3 times. And you were still loaded up with long-term low-interest securities that were uninsured. So you failed to anticipate the impact that a rising rate environment would have on those deposits, no?
Congressman, as I mentioned in my written testimony, and I think this is very important, our balance sheet is constructed, our asset side, with securities and also loans.
I get that.
Those loans are variable rate, meaning as rates rise, we make more money. And so my view is you have to look at the entire balance.
You had 97% of your deposits were uninsured. 97%. Those are the first deposits to run. These are the Kenyans of bank deposits. They run the fastest and they run first. And you failed to appreciate what would happen when rates went up. But the Fed told you, the Fed made public their intent in December of 2021 that they were going to raise rates. So I realize you didn't have, is this a period where you didn't have a chief risk officer? Is this correct?
No, it is not.
It's not. So what did your risk officer advise you at that point?
Congressman, I don't recall specifically what the discussion was around that. I know that, again, my memory is that.
So look, it shouldn't take a risk officer to figure this out. I mean, look, so you had $91 billion of assets that were locked into long-term low-interest securities. 91 billion. And as rates went up in 2022, the value of those assets plummeted, went from 91 billion to 21 billion, and everybody headed for the door. How could you not anticipate that? How could you not understand the impact of a rising rate environment on your deposit base? I don't get this. And I find it hard to believe that no one at the bank anticipated this. What's your response?
Congressman, what is the specific question?
The question is, what was your alternative reality if you're not facing the facts, and if you're not acknowledging what's going on in front of you? What was the alternative scenario, the alternative reality that led you to keep these? And these were many of this. So this 91 billion in assets were held to maturity. So that really frightened people when you had to start selling those at a considerable loss and actually realizing the losses of this strategy. And I'm just asking for an explanation of why you did what you did in the face of what was going on.
Congressman, it's a complicated answer in the sense of looking at the balance sheet. You have to understand the assets, and again, our loans were variable rates, so they benefited from higher rates. So that's part of the equation. The other part.
Here's what gets me. So earlier in your testimony, you're blaming the Fed for not telling you what to do, not raising the interest rate issue with you, when a high school student in economics or finance would be able to figure out the danger that you were in. Mr. Chairman, I yield back.
The gentleman yields. The gentleman from Texas, Mr. Williams, is now recognized.
Thank you, Mr. Chairman, and in full disclosure, I'm a car dealer from Texas. And Mr. Shea, in the recent New York State Department of Financial Services Internal Revenue review regarding the supervision of Signature Bank, it showed that your bank did not develop a control framework in line with its growth and did not have a liquidity management plan that matched its risk profile. In the past and leading up to Signature Bank's collapse, regulators had identified weaknesses in the bank's liquidity risk management, yet Signature's management failed to act on or remedy these warnings. You are in the position you are in right now because you failed to adequately manage your liquidity risk and positions. So my question is, when you were made aware of these liquidity risks, and why were they ignored, and did you express any disagreement with the Fed regulators' findings when they were laid out to you?
Yes, as chairman of the board, I was aware of these, and the bank was taking substantial steps to address them, including improving stress test modeling, improving other modeling, diversifying further the deposit portfolio mix, limiting the amount of deposits, seeking additional sources of liquidity additionally, including issuing brokered CDs, which the bank had not previously done, that were insured, entering into repurchase agreements or arranging to get into repurchase agreements, negotiating repurchase agreements with primary dealers, curtailing lending to lower the amount of need for deposits, and maintaining a high quality lending portfolio, as well as a shorter term securities portfolio consisting of readily marketable government agency and other securities.
All right. In 2022, we saw the Federal Open Market Committee raise interest rates at a speed that we'd not experienced since the 80s, and I remember the 80s, and a belated attempt to address the runaway inflation sparked by the partisan American Rescue Plan, which injected $1.9 trillion into the economy. This rise in rates caused the assets that the Silicon Valley Bank had invested into decline in value. We know this, and when withdrawals at SVB began to rise at a rapid rate, these assets were sold at a loss. So, Mr. Becker, when the bank invested $80 billion in long-term mortgage-backed securities, was there a plan in place to adapt to rising interest rates and decrease in value of these bonds? And Ms. Wagner touched a little bit on that.
So, Congressman, a couple of points. One is the investments that were made in 2021, those were invested in government securities, and those are very pledgeable. If you need liquidity, you can borrow against them. And by the end of 2022, we had $69 billion of availability for liquidity at the end of the year. Second point is that those securities actually pay down. So roughly $12 billion per year of those securities would amortize down. And that was from the held to maturity portfolio. We also had availability with our available for sale portfolio and then our cash. So when we looked at it, we believe we had adequate liquidity to support several different scenarios.
Okay, and Mr. Becker, finally, the bank did not have a chief risk officer. I think you've talked about that for 8 months between April 22 and January 23. This seems as if your team did not care about risk. And even though there were several warning signs that had been brought to light, you and your team did not think to address the risk and someone in place to manage and mitigate those risks. So you did, however, bring on Chief Risk Officer in January, but then proved to be too little too late. So Mr. Becker, quickly, during the time that Silicon Valley Bank did not have a Chief Bank Officer, who was overseeing the risk management framework, and what efforts did you make to find and hire a qualified candidate?
Congressman, I respectfully disagree with the characterization that we didn't take risk management seriously.
You didn't have anybody in charge, but that's fine.
We had a team of people, of senior executives in risk leadership positions. We created the Office of the CRO, Chief Risk Officer, that reported to me and reported into the chair of our risk committee. And we were actively engaged in risk management broadly across the organization and being responsive to the regulatory feedback.
It's kind of like in my car business, selling cars, but I don't have a sales manager. I yield.
The gentleman yields. The gentlewoman from Ohio, Mrs. Beatty, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Ranking Member. I'm not sure where to start. So let me start with making this statement. I want to take a moment, Mr. Chairman, to acknowledge the hardworking Americans who was harmed by this glaring mismanagement at your banks. Public pension funds nationwide lost millions of dollars that were invested in the Silicon Valley Bank and Signature. In my hometown, in my 3rd congressional district, the home of Ohio State Teachers Retirement System, took the biggest hit. Over $27 million invested in your bank. Meanwhile, with the reports that have come to light since the bank's collapse in March, we know that executives at your bank earned millions of dollars in bonuses, stock sales, increased executive compensation while you ran the banks into the ground. And I don't need to go through it. We've heard it on both sides of the aisle, from failing to address supervisory recommendations, taking on significant interest rate and liquidity risk, and inadequately matching the bank. Meanwhile, teachers, like my sisters, firefighters, and other public servants lost millions that were invested through your public pension funds. So let me do 2 things quickly. Mr. Scott ran out of time, so any one of you can answer his questions. Who made the decisions to continue with these uninsured deposits? We'll just go down the line. Just give me an answer. Who made the decisions? Mr. Becker?
The decision is around our uninsured deposits, relates to our strategy, which has been our strategy.
So who implemented the strategy? Who did it? Who made the final decision?
The strategy direction of SVB.
So is your signature on it? Do you take the responsibility
and
for it?
myself.
Do you? Okay, thank you again. And thank you earlier for acknowledging and taking responsibility. Mr. Shea, we'll go on. Second, your answer.
Yes, the strategy
So does that mean you take that
was to
responsibility?
serve, the strategy was to serve mid-sized companies.
Okay, but do you take the responsibility for that strategy? You know, strategy is a word. Who implemented it? Who was ultimately responsible? Is that you?
That was the founding principle of Signature Bank.
Same question.
The Board of Directors and Executive Management implemented a successful business strategy that lasted for 37 years.
Okay, because the clock is running, let me go into the next question, please. Okay, now I've heard you've been there 30 years, 12 years as CEO, a lot of time. Founder since 2000, co-founder of Signature Bank. CEO since 2009 to present. Okay, how much money did you make? What was your salary for 2022 and 23 and bonuses? Salary and how much in bonuses, dollars and cents?
For 2022,
yes,
my salary was just over $1 million, and my incentive compensation was $1.5 million.
Okay, next.
My last salary was $900,000 and $1.7 million bonus.
My last salary was $990,000 and my bonus was $1.5 million.
Okay. Do you know, let me start with you, Mr. Becker. You know what MRA stands for in MRIA, right?
I do.
Okay. So, same for everybody. You understand what that is, right? Okay. So, Mr. Becker, in the recent report on the failure of Silicon Valley Bank and the Federal Reserve stated that it issued multiple supervisory issues on MRA and on MRIAs. 31 supervisory issues pertaining to capital planning and positions, liquidity and risk management, governance and controls, all these strategies you all talked about, including Bank Secrecy Act and the anti-money laundering, okay? 12 of the 31 open issues on the MRIA. And for those watching that don't know, when you put the I in it, it means immediate. That means it needed immediate attention. Can you explain to me, after 3 years, why we still had, and up at the collapse, we had not answered, you had not answered those 31, only 12?
Congresswoman, as I said earlier, we were extremely responsive to the regulatory feedback, and all the matters you're describing.
Do you know
were
what
in
those
process.
12s are? Because my time is run out. Do you know what they were?
I can't speak to every single one, but I know them.
I'm sorry, my time has expired.
The gentlelady's time has expired. The gentleman from Georgia, Mr. Loudermilk, the vice chairman of the committee, the subcommittee, is now recognized.
Thank you, Mr. Chairman, and appreciate you all being here today. This is a very important issue, as you are all aware. Mr. Becker, Chairman Andy Barr asked you about the departure of the Chief Risk Officer for Silicon Valley Bank. And in yesterday's hearing before the Senate Banking Committee, you said that this was spurred, at least in part, by recommendations from regulators who were concerned about her experience. Can you tell us a little bit more about the specific concerns the Fed regulators had about your CRO's experience?
Yeah, Congressman, as I described yesterday, the feedback was observations from the board of directors, from the regulators, from myself, internal audit, and as we started to approach $250 billion level, looking at individuals, especially in the risk area, that had that experience of even larger institutions was the feedback that we were getting. And so that's what we acted on.
And according to her public LinkedIn profile, she had over a decade of experience in enterprise risk management prior to her 6 years at SVB. In her 6 years of employment with you, what role did she play in developing the bond portfolio that contributed to SVB's collapse?
Our chief risk officer would have sat on our asset liability committee, and she would have been a voting member on that committee. Given that I wasn't on that committee and wasn't part of it, I don't know the discussions that she would have had in overseeing the overall portfolio and the strategy around it.
And I understand it takes time to find good executives, but why did you decide to dismiss her without having a successor already in place?
As I mentioned earlier, based on the feedback, we thought it was best, and we consulted with the regulators, and clearly the board was driving this as the chief risk officer reports into the risk committee, and it was decided that having our chief risk officer on board as a consultant that's available made the most sense as we built out our office of the chief risk officer and had those senior leaders in risk management reporting to myself and reporting into the chair of our risk committee.
So you felt that was better than even just keeping her in an interim position?
We did.
It's reported that SVB's risk committee met 18 times in 2022, more than double the number of meetings in 2021. At any point during these meetings, was the interest rate risk on SVB's balance sheet discussed?
Congressman, the 18 meetings were a variety of different topics. It was around governance and controls and looking at the metrics around our, it's called a risk appetite statement. So it's what level of risk are you willing to accept as an institution? And so the liquidity risk would have been the main area where that would have been stressed, and that was definitely discussed.
Do you remember when the first time the risk, interest rate risk was brought up?
Again, my recollection was liquidity risk was one of the metrics that was reviewed, and so that would have been discussed across many of the risk committees going back for a long period of time.
Would you say that that was one of the compelling reasons why you had double the number of meetings in 2022 than you had in 2021?
I wouldn't say that was the main reason or really the compelling reason. It was really overall enhancing our risk management across the entire platform, including governance. And so we had changed the risk committee structure about a year earlier, and so it was making sure that we had the right risk governance across the entire platform.
I also want to clear up some confusion regarding the Office of Chief Risk Officer Committee and the Risk Committee. Were these two entities the same, and if not, were they substantially similar in composition and function?
So the Office of the Chief Risk Officer was actually management level, so it did not include any board members. The Risk Committee was a board level committee.
Okay. I see I am quickly running out of time. I won't have time for additional questions, so I'll submit those for the record, and Mr. Chairman, I yield back.
Thank you. The gentleman yields. The gentleman from California, Mr. Vargas, is now recognized.
Thank you very much, Mr. Chairman. I want to thank you again and the ranking member for putting this together. Appreciate it. I actually don't like being in the position that we're in today, failure. I'm a religious liberal. I believe in God's mercy and redemption. And when someone's poor and does something wrong, I believe in redemption for them. And when someone's rich and fails, I believe in redemption for them. So I'm not going to stand here and beat you up. I'm not going to do that. I'm disappointed, obviously, I think, as all of us are, and hope that you cooperate with the government so we can fix some of the problems. And one of the problems that I see is that it seems like the banks, all of your banks, were reactive and not proactive in this situation. And I think you're calling it unprecedented circumstances and events, and I agree with those. I mean, when you move so much money, run on the bank that's so quick and digitalized, it's unforeseeable. Not unforeseeable, but again, it's unprecedented. What can we do to begin? I know those on the other side of the aisle usually think of deregulating in a situation like this, and probably most of us on the aisle, and certainly me, I think about regulations, not deregulations. What can we do in this situation, the situations you find yourselves in, for banks not to have this problem? I see that this could affect virtually any bank except for the really big ones. Anytime that social media or short sellers decide to manipulate the stock, they can do that quite quickly through social media, and all of a sudden money can be moved. What can we do? What can the government do to prevent this so people don't lose their money? Who would like to take it? Roffler, why don't you take a shot at it first? Mr. Roffler.
Sure. Congressman, it's a very good question, one obviously that, reflecting on the last 60 days, I thought about frequently. And sitting here today, it's very hard for me to give any good advice for that because as we learned through March 9th, we were in a strong position. Yes, 2023 was going to be a bit more challenging than 2022 from an earnings standpoint. But when contagion hit after the failures of the two other banks, panic sets in. And so I think my recommendation to others would be.
But is there any trigger, for example, yeah, the panic hits at Wall Street too, so we've put in triggers. We've put in things that slow the system down. Is there anything we could do for that, to slow the system down? Because I think that the banking system is sound. It's resilient, it's sound, but there's always the opportunity for panic. There's always opportunity to make money in panic. I mean, not everyone lost money in this deal. Short sellers made money, and I think we need to investigate them to find out what happened. Is there something that we can do, some trigger, something that the government can put in place so we don't have these runs on the bank?
So I would share that on March 12th, I think they adopted one of the lending programs which banks could utilize, and I think banks did utilize that successfully, so I think that was a good step. But at the end of the day, when the panic sets in, it's really hard to regain confidence. And so absent some evaluation of the insurance on deposits, which I know the FDIC, I think, is requesting comment or offer proposal, I think that's one thing that would be worth looking at, because that can at least calm the waters.
Yes, Mr. Shea, that same question. Thank you, sir.
I can't give you a solution, but I can tell you what I believe is a problem that needs to be fixed. And I certainly saw it and felt it that Friday afternoon. It was literally nothing. The customers didn't want to hear anything that I spoke to. They just wanted to get to, I remember, I need to get my money to JP Morgan Chase because the government won't let them go. I need to get my money to Citibank because the government will make sure they save them once, they'll save them again. I mean, it was panicked calls. I need to get my money to a too big to fail bank because they might let you go. I'm not a bank analyst. I don't know banking. I'm just running a plumbing supply area. I'm running a school bus operating business. I'm running a healthcare provider service.
Okay.
Most of them have
time.
deposits well in excess of the insured, and they didn't want to miss payroll. And so there was really very...
My time is up, but I appreciate your answers. But I do think we need to take a look at that, because I do think when the panic sets in, there's no way to stop it unless it's insured. Thank you, Mr. Chairman.
The gentleman yields back. The gentleman from Tennessee, Mr. Rose, is now recognized.
Thank you to our chairman and ranking members, and thank you to our witnesses for being here. I know it's not an easy environment, so appreciate you being here to share your insights with us. I want to back up, and if all three of you will hang with me for a second and go back 3 years or so and think about where you were and what decisions you were making in your banks, and then let's imagine that you could have seen forward, that your crystal balls were working particularly well. If you had known, and I'll start with you, Mr. Becker, if you had known that in 2022 inflation would reach a 40-year high, would you have managed the bank differently going into that period?
Congressman, I think about your question a lot in hindsight, and I think that is very hard because I go back and think about the decisions that were made. We didn't have access to that information. Yeah. We only had the information that was available to us at the time.
Well, let's imagine if you had known that and you could have anticipated the attendant reactions to that. My guess is you would have made different choices. Is that true?
I think if we knew, and our team that was making investment decisions would have known that there was going to be the fastest rate rise in 40 years, yes.
And you've anticipated my next question. If you could have foreseen the fastest rate rise in history, you definitely would have managed your balance sheet differently.
I think it's likely we would have managed our balance sheet differently.
And Mr. Shea, same two questions. If you could have foreseen the inflation rate and then the attendant rise in interest rates, you would have made different decisions, right?
Well, I can't say what we would have done hypothetically, but what I can say is that the plan that Signature Bank presented to open on Monday, March 12th, assumed that we were selling the entire available for sale portfolio, taking any losses that were there, and still were well capitalized after that and met all regulatory definitions. So the Signature Bank portfolio of available for sale was of a controlled interest rate risk and was not it was not a substantial, it was an issue, but not one that would have caused the bank to even be not well capitalized under regulatory standards.
Mr. Roffler?
Thank you for your question, Mr. Congressman. I have thought about it a lot. And the reality for the last 3 years and frankly the 37 years in our bank's history, our goal each and every day when we woke up was to serve clients. And that's what we did. We helped people buy homes, we helped nonprofits, we helped small businesses, and we would have continued to do that. And I think the events that unfolded on March 10th were entirely unforeseeable. When contagion and panic spread, it's very hard to control. And so I think that our business model, we were profitable, we were strong, we were well capitalized, and everything changed on the morning of March 10th.
If the Fed had opened the discount window allowing you to borrow against your bond portfolio at par before this all happened, and I'll direct this to you, Mr. Becker, would that have changed do you think we'd be sitting in a different place if that facility had existed in, say, February and following?
Congressman, I actually don't know the answer to that question. I think it would have been hard because of the fact that on Thursday there was $42 billion, and on Friday there was $100 billion requested to be exited SVB. I don't know if that would have helped or not, or would have helped. I don't know if it would have protected against the bank run.
And I'm wondering, Mr. Becker, your bank had an extremely concentrated level of risk or deposits in certain areas. What caused you and your management to believe that those deposits would be sticky if the waters got choppy?
Yeah, as previously mentioned, that's been our model since I recall, working with technology and innovation companies, and our goal at the end of the day was to serve them in a way where that loyalty would be created by being the best place for them to operate, which I believe is exactly what we delivered on. And so that's what we believed to happen. That's what history had taught us. And so we believe that to be the case.
And in the remaining few seconds, I'm wondering if your bank ever turned down deposits as you grew at an extremely fast pace. Was there ever a time when you said, we better not take any more deposits from this customer? Please, if you will, answer that for the record. My time's expired.
Real quick answer.
Yeah, so the majority of the cash that came in that I talked about with the growth came from existing clients. And so coming from existing clients, we felt that was the right thing to do, was take those deposits.
You can answer the rest for the record. Thank you. The gentleman's time has expired. The gentleman from Illinois, Mr. Kasten, is now recognized.
Thank you, Mr. Chairman, and thank you all for what I know is a long, difficult day here. Mr. Becker, lots of my colleagues have talked about the fact that your chief risk officer was terminated in April 22. I think your written testimony mentions that was under some constructive pressure from regulators. You didn't disclose that you were operating without a risk officer until your proxy statement at the beginning of 2023. Were regulators aware of that decision to delay the announcement to your shareholders that you were operating without a chief risk officer?
Congressman, the decisions around disclosures, we have a process that we would go through. The legal team would drive that.
I'm just asking whether regulators, we have an oversight responsibility with regulators. Were regulators aware of that decision to go 11 months without notification to your shareholders?
I know the regulators were aware of the decisions around the chief risk officer. I don't know if they were aware of any disclosures.
Okay, but presumably it was your opinion that was not a materially significant fact to disclose for 11 months.
Congressman, that the decision around disclosures is made by, it's a process.
Okay, but you were the CEO. Okay, during that 8-9 month period, you doubled your number of risk meetings. Did regulators participate in those risk committee meetings?
Congressman, the risk committees that I was in, I don't recall them participating in any of those meetings.
Did you participate in all of those meetings?
I did.
Okay. You mentioned in your opening remarks that March 8th, which was a day that shall live in infamy, you announced the sale of equity to Goldman. You mentioned the Signature Bank collapse. That was also the day that you announced, booked, I think, a $1.8 billion loss on the sale of bonds, also to Goldman. When did you initiate the process of selling equity and debt to Goldman that commenced on March 8th?
To clarify, Congressman, the sale of the securities was to Goldman. The issuing of new shares and securities to raise equity was not to Goldman. They were our investment.
Mediated, but when did you initiate the process with Goldman on both the equity and the debt transactions that culminated on March 8th?
We started those discussions at the last day or two of February.
Okay, and when were you'd mentioned concerns about liquidity risk, interest rate risk. Was that in response to those concerns? And when were those concerns raised that would have caused you to initiate the process to raise equity and sell debt?
Yeah, the process, and again, my recollection towards the end of February, our CFO and I were having a conversation about, if you look at, and the last roughly 2 weeks to 3 weeks, the 10-year Treasury had jumped significantly.
And I'm not looking for the why. I'm just trying to understand the calendar of who knew what when. Because sold March 8th, you're saying you started the process end of February. When were there concerns raised that you needed to start this process? Was that the day before? Was this January?
Congressman, there weren't concerns raised that forced us to do that. We decided to do it and talked about it at the end of February, and we engaged our board, we engaged our regulators, and we talked about it.
And I'm sorry to be cut, but I want to get to it. So you sold 3.6 million of stock personally on February 27th, which would have been right about that time. I understand that process was initiated January 26th. Given all this was going on, did your risk committee sign off on that sale?
The process, and this has been the process for as long as I've been at the bank, is that when you want to sell stock, you put together a 10b5-1 plan. It's reviewed by our legal team.
Okay, but given the timing, you understand my question. Was the risk committee, did they sign off, or was this just they were notified?
I don't think the risk committee would have been notified. It was the legal team that would have concurred with my belief that we didn't have material information.
You've mentioned several times that you don't recall any discussion around interest rate risk prior to 2023. Do you recall concerns that you were overinsured against interest rate volatility?
Can you clarify the question,
Congressman? Well, you've said you don't recall concerns that you had an exposure to interest rate risk, and yet you sold down 97% of your interest rate hedges on your available to sell portfolio during 2022. So was there a concern raised that you were overinsured against that risk? Because there was a decision made to essentially take on long-term risk in exchange for a short-term transfer to equity.
As previously mentioned, as far as the decisions around the hedges, 2 points. One is it was against the available for sales portfolio, which is the smallest.
Yes, but it was 97%. You started with 15.3 billion insured, and you ended 2022 with 563 million insured.
The witness can answer the rest of the response for the record in writing, and we will take a brief 5-minute recess to allow our witnesses to take a quick break. I'd ask that they return promptly, and we will return in just a little after the top of the hour. The committee stands in recess. The committee will come to order. Thank you for everyone's indulgence on the break. The chair now recognizes Mr. Muser for 5 minutes.
Thank you, Mr. Chairman. I'd like to start with a question for each. Mr. Becker, how many matters requiring attention MRAs did your bank receive?
We had 31 at the end.
Thank you. Mr. Shea, how many did you receive?
I don't recall.
Was it more than zero?
I don't recall.
Don't recall.
It was more than zero, but I don't recall.
Okay. Mr. Ruffler, how many?
We had 0.
You had 0. So it's 0. How is it you had 0 if you eventually collapsed?
As I mentioned earlier, I think it was part of my testimony, the bank maintained very strong communicative relationships with our regulators. We addressed feedback as it was received. They provided supervisory recommendations and we addressed them. If you think back to March 9th, it was a very strong day for the bank and the bank was in a strong financial position and we were actually benefiting from some of the uncertainty relative to other banks. And on March 10th, everything changed.
Fine, but why you? Why were you perceived as next?
It's a very good question, and it's one I'm not sure I can answer. I think on March 9th, late in the day, similar to how we were discussing earlier, there was some media, social media linking First Republic and Silicon Valley. I'm not sure if it was geographic based, if it was a small client overlap base.
All right, thank you. Mr. Becker, when the bank was reviewed, when your bank was reviewed by the Fed in 21 and 22, they alerted your bank that the risk management programs were not effective and that the liquidity risk management practices were below supervisory expectations. What was your reaction to these communications from the regulators?
So, Congressman, maybe 2 points around that. One is we certainly take all the regulatory feedback into consideration and respond as quickly as we can. The second clarifying point is really how we were rated. The LFI rating for liquidity was the second highest rating that could have been given, and under the CAMELS rating, we had the second highest rating under liquidity as well.
What was your senior leadership team? Did they give you a rating that high? I mean, did they actually see a hurricane? Nobody perceived any sort of hurricane winds coming in, and hey, we need a bigger boat. We might be running into trouble. No one felt that you had any concerns in your investment portfolio or your type of deposits? You needed a regulator to tell you that?
Congressman, we looked at several things. One is our capital
the regulators
ratios.
missed it and your management team missed it?
Congressman, the capital ratios that we had were exceptionally strong, and our liquidity, at the end of the year, we had $69 billion worth of borrowing access plus cash.
I know some of your
we
numbers,
certainly
but
believe we
you
had
didn't have
the
any conversations with the regulators during this time? Hey, guys, we got 57% in treasuries. Jerome Powell saying interest rates are going up. We're losing billions of dollars. Most of our deposits are beyond the FDIC insurance. None of those conversations took place?
Congressman, we were talking about risk management on a regular basis. And so we looked at our risk appetite statement and the metrics, and if there were any concerns, we addressed them as quickly as we could.
Okay, in November 22, interest rate risk simulations are not reliable. You received that notification from the Fed. No alarms went off?
Can you repeat that question?
In November of 2022, the Fed issued you a supervisory statement, and I quote, interest rate risk simulations are not reliable for your bank. No?
And so the question...
You were reviewed in November of 22.
Yes.
And you did not receive a sky-high rating. You received a high-risk rating, yet nothing was really done. That was November of 22.
The response that we provided to interest rate risk management and liquidity risk management was throughout 2022 and into 23. And so we were working on managing the higher interest rates, making sure we had enough liquidity to support our clients, and making sure that we were taking care of interest rate risk.
I don't know what business world that sounds reasonable, but it doesn't to me. Mr. Shea, I'm going to move on. Signature Bank collapse, according to the FDIC, was due to poor management and that you did not heed FDIC examiners' concerns and not responsive to addressing FDIC supervisory recommendations. What say you to that?
As chairman of the board, I believe that Signature Bank was actively addressing regulatory.
I yield back, Mr. Chairman.
Gentleman yields. Gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you. You know, several of my colleagues have characterized your time spent here today as possibly being uncomfortable. I'm really okay with that. Personally, I'm good with your being uncomfortable because my constituents in the Massachusetts 7th were very uncomfortable when SVB collapsed. They were afraid in the face of uncertainty about the status of their mortgages. Tech companies couldn't make payroll. Small businesses were unable to receive payments. So they were very uncomfortable. So I'm quite fine with your being uncomfortable today. True enough, the FDIC acted quickly to make depositors whole. Today's hearing was still necessary because this tragic, avoidable sequence of events demands accountability. Mr. Becker, in your opening statements today and in your response to questions, it mirrors your testimony before the Senate yesterday. Lots of finger pointing, blaming, passing the buck, blaming social media, contagions, a 2018 Republican bill which you lobbied to help pass, and even your own employees. Now, this question might feel a bit like Groundhog's Day, but here it is. And I want a yes or no answer because I don't have the patience for filibustering, and the American people deserve more than the niceties of a committee hearing. So yes or no, do you accept responsibility for the harm and damage caused by your actions across the financial system and to my constituents in the Massachusetts 7th? Mr. Becker, yes or no?
Congresswoman, I accept responsibility for the decisions that were made.
Yes or no?
At the time.
Yes or no, do you accept responsibility?
I accept responsibility for the decisions that were made with the information that we had at the time we made those decisions.
The bank failed on your watch, period. Between 2018 and 2023, Federal Reserve sent your bank 68 matters requiring attention, MRAs, and matters requiring immediate attention, which highlighted the liquidity and risk management deficiencies of SVB. This is building upon the questions by my colleague across the aisle. Were you aware of these supervisory notices, yes or no?
Congresswoman, I disagree
yes or no?
with the numbers that you were
Yes
using.
or no? You're a very smart man. Yes or no?
I was aware of the 31 regulatory
All right.
findings.
So SVB was definitely aware of these notices, yet you and your executives repeatedly ignored them. You failed to address the obvious risks that were repeatedly pointed out to you year after year after year. You blame social media. You say similar banks experienced the same thing, so it's not your fault for what happened ultimately. Failure to address risks after 68 supervisory notices is absolutely unacceptable, yet throughout the last 5 years, your pay skyrocketed and you continue to reap the benefits of mismanaging your risk. Maybe that's why you're not as uncomfortable as I think you should be today, because you're sitting on a $1.5 million bonus. Way to fail up. You received over $9.9 million last year in compensation, as well as a $1.5 million bonus. In light of your tremendous failure to manage obvious risks, do you think that you truly earned your salary and your bonus? Yes or no?
Congresswoman, to clarify the numbers that you're talking about, the incentives that were set up.
Please don't tell me that you trust the board. That's a cop-out. Yes or no, do you again, way to fail up. I mean, that's just consistent for so many reasons. But the answer is no. You have not truly earned your salary or your bonus, and that's why we need accountability. The American people deserve accountability. That includes clawing back bonuses, investigating you for gross negligence, malpractice, and greed. Congress must reverse the dangerous deregulation that you lobbied for and send a strong message to bank CEOs that risky behavior that jeopardizes our financial system will have severe consequences. I yield back.
Gentlelady yields. The gentleman from South Carolina, Mr. Timmons, is recognized.
Thank you, Mr. Chairman. We currently have $32 trillion in debt. Our debt to GDP ratio is 120%, the highest it has ever been. And yes, we have a debt ceiling fight running right up to the deadline, but Congress spent $7 trillion, of which $5 trillion was done mostly on party line votes. The Democrat majority has not only spent money we don't have, but their fiscal policy has caused out of control inflation, which we can draw a direct line to the failure of your banks. Give or take some gross mismanagement on your part. The Democrats' $7 trillion in unnecessary spending over the last 4 years has caused inflation. Some of my colleagues across the aisle disagree with that causal relationship, but I think they are the only ones still trying to defend their opportunistic government handouts. I think your failed banks are the first casualties of the Democrat spending spree, and I think your banks are just the beginning. I think all of your employees who no longer have jobs will soon be joined by more hardworking Americans. But I guess let's turn back to the gross mismanagement issue. Mr. Becker, do you feel that recent reports written by the Federal Reserve and California Department of Financial Protection and Innovation are fair assessments of what happened before and up to when your bank was placed into receivership?
Congressman, the feedback that I think was in the GAO report was accurate in the sense that we were responsive to the regulatory feedback and were actively remediating any concerns that were brought up. So I believe we were very, very attentive to the feedback we were receiving.
So the Fed's report on your bank's failure lays blame with you and your senior management team. Can you please describe the organizational structure of your risk management team, starting with you, then the CRO, and on down from May 2022 to January 2023?
Yeah, I'll start, Congressman, at the highest level. We have the board of directors, which is responsible for the overall governance of the institution. We have a risk committee that is responsible for the oversight of the risk of the institution. That risk committee has oversight, again, over the risk of all of SVB, or had oversight. We had several risk committees, management risk committees, one of which reported directly up to the risk committee. We had what would be called as 3 lines of defense. So we had internal audit, we had independent, which reported up to our audit committee. We had a risk structure that reported up to the risk committee.
But as you
we had our
previously
business.
testified, you didn't have a chief risk officer for that time. Is that correct?
We had an office of the chief risk officer for the majority of 2022.
But not in the last 8 months prior to the bank's failure.
We had an office of the chief risk officer that was overseeing risk management for the institution.
Okay, can you also just explain to me the concept of safe space catch-ups? What was that in SVB? Safe space catch-ups? It's been widely reported that your bank spent enormous amounts of time with your executives promoting safe space catch-ups. It's basically a diversity, equity, inclusion endeavor to make people feel welcome in the bank.
Congressman, that does not ring a bell with me. I don't know what that would relate to.
Can you estimate how many of your senior risk officers were also leaders in your company-wide diversity, equity, inclusion program?
Congressman, I don't know the answer to that question.
It would appear that a lot of time was spent, your website prior to it being shut down had enormous amounts of emphasis on that, and it seems that there was a lot of time spent on things that do not cause banks to succeed and things that make people feel good, and I think that that was part of the problem. Moving on, some are proposing increased capital requirements going forward, and I'm going to ask each of you this question. Would increased capital requirements have avoided your bank from failing, Mr. Becker?
I can't comment on that because I don't know what the requirements would be in this structure.
If they were 50% higher, if they were 100% higher than the previous capital requirements. I mean, they're proposing 10%, but I mean...
I don't know the answer to that question, Congressman.
Mr. Shea, would increased capital requirements have caused your bank to not fail?
I don't think so. As one depositor I spoke to on Friday afternoon said, unless you have $1 of cash in your vault for every dollar, I have to move to a too-big-to-fail bank.
And Mr. Ruffner?
Similar, I would say that the capital requirements we have now are very strong, and I think any change that might be considered should consider the impact to regional banks and community banks, and be careful to not have a one-size-fits-all, because I grew up in a small town in Wisconsin. I know the importance of community banks, and you want to make sure they can continue to provide the service and support the communities because they're so integral.
I think we agree on that. Thank you. Mr. Chairman, I yield back.
Gentleman yields. The gentleman from Nevada, Mr. Horsford, is now recognized.
I thank the chairman and the ranking members for the hearing. I just have some very specific questions. So again, if you could respond with brevity. Mr. Becker, do you take any accountability for Silicon Valley Bank's failure? Yes or no?
Congressman, I was the CEO of the institution, so I'm responsible for Silicon Valley Bank.
Mr. Roffler, do you take any responsibility for First Republic Bank's failure?
As I said earlier, regardless of what caused this, I take responsibility for our clients and for our employees every day and making sure they're taken care of and supported.
Mr. Shea, do you take any responsibility for Signature Bank's failure?
As chairman, I believe that I fulfilled my responsibilities responsibly.
Well, what's very troubling about each of your responses and sitting here is the idea that your lack of governance and oversight and mismanagement has disrupted the entire regional bank ecosystem in our country. And as a result, our committee and other committees of jurisdiction are now having to step in to figure out what we can do to help protect small businesses and other depositors to make sure that their lives are not further impacted. So it's mind-boggling to me that you can't take full responsibility for your actions. Do you agree with GAO's statement that your bank's failure had to do with the poor governance and unsatisfactory risk management practices? Yes or no, Mr. Becker?
Congressman,
yes or no?
I take ownership for the decisions that were made.
Yes or no, do you agree with GAO's statement that it was poor governance and unsatisfactory risk management practices?
Congressman, I take responsibility for the decisions that I made.
That's a non-answer. Mr. Shea, do you disagree with GAO's statement that your bank's failure had to do with the poor governance and unsatisfactory risk management practices?
I can't speak for the regulators. I believe the reason for Signature's closure was due to the extraordinary events that happened on that day.
Mr. Roffler, same question.
Congressman, I don't believe the GAO report spoke to First Republic.
Well, to be clear, GAO's assessment clearly indicated that it was due to mismanagement of the two banks in particular. And I believe that if a bank fails due to misconduct and mismanagement, then executives should be held financially accountable. That's what the average person, the average worker, the average consumer has to deal with when they make decisions. So out of curiosity, Mr. Becker, did you receive a compensation package after your departure from Silicon Valley Bank upon its failure? And if so, do you mind disclosing how much?
After I was terminated on March 12th, I did not receive a compensation package.
Mr. Roffler, did you receive a compensation package after your departure from First Republic Bank upon its failure? And if so, do you mind disclosing how much?
I have not received a compensation package following the closure of First Republic.
Mr. Shea, same question.
No.
So let me ask a different question. Should bad behavior or poor judgment or terrible managing be financially awarded? I think absolutely not. And while we continue to hear very concerning reports that executives are taking huge payouts as banks fail, I am left to wonder, as many of my constituents are, if your compensation packages incentivized this crisis in the first place. And what's so frustrating to me and a lot of my colleagues about all of this is somehow that you feel as if you shouldn't be held accountable. Meanwhile, hardworking Nevadans and Americans across the country are held to higher standards of accountability in the work that they do each and every day. If an ordinary American took out more money in their account than what was actually available, then they would be charged an overdraft fee. If an ordinary American was 1 day late paying a credit card bill, they would be charged a late fee. Yet when a bank executive poorly manages their bank, which eventually fails, they are paid multi-millions. This is what's wrong, this is what's broken, and it must be fixed.
Gentleman's time has expired. The gentleman from South Carolina, Mr. Norman, is recognized.
Mr. Becker, I think earlier you mentioned you'd been in banking for 30 years, 12 of those as CEO.
Yes.
Mr. Shea, how long have you been in banking? How long have you been in the banking arena? Cut your mic on. I know you were director, but how long have you been in the banking sector? How many years?
Oh, how many? Since about 30 years.
30 years.
Or 30 or more years.
Mr. Ruff, how long have you been involved in the banking arena? Been employed as a banker?
I've been at First Republic employed for 13 years, and before that I was with KPMG.
For how long?
16 years.
Okay. All of you have seen ups and downs in the market. Any of us, and I'm in the real estate world, development world, it's ups and downs. Mr. Becker, I find it hard to believe that, and your company grew from, I think, 40 billion up to 210 billion. I find it hard to believe that, particularly with the camel ratings that y'all had received and the warnings, that whether it was an MOU in writing or you described it in words, that it really wasn't an MOU, it was more of a conversation, that to not hedge your bets on the deposits, 94% were uninsured. How did you reason with that? How did you come to that conclusion? I know it paid higher returns, but was that with 94% of your deposits being above the 250,000? How did you rationalize that?
Congressman, that was our business model that, again, my entire history, we had commercial clients and technology and life science clients, and they tend to have higher levels of deposits. That was our strategy.
But you took their money and you put it in an asset that you took, according to my what I've have, you had 21 billion in securities. You sold at a $1.8 billion loss. Is that correct?
On March 8th, we contemplated raising additional capital and selling our available for sale securities portfolio, as I articulated in my written testimony.
Okay, and you mentioned, y'all were without a risk officer for 8 months. You've got 2,000, roughly a little over 2,000 employees. Did you happen to have a credit analyst or a financial analyst or a fund manager in that 2,000 employee number?
Congressman, to clarify, we had over 8,000 employees, and we had roughly 1,000 employees that had the majority or all of their responsibilities in risk management.
And nobody questioned what you were doing with the funds?
Congressman, the investments that were made in 2021 by our Treasury team and overseen by our ASA Liability Committee were invested in government securities.
Okay. Wasn't a good decision, was it?
Congressman, the decision that was made, I believe, was in the best interest with the facts that they had at that time.
Okay. Let me ask the question a little bit differently. I know my friend on the other side mentioned compensation. Were bonuses paid out in the last month of or close to the time that the feds took over?
The 2022 incentive compensation payments, as determined.
Were bonuses paid out?
Bonuses, incentive compensation payments were determined at the beginning of the year and paid out on March, I believe, 9th. Then that date was determined by our HR department and our finance team earlier in the year. That date was not changed.
But were the bonuses paid out after you had notice of the problems that you had at Silicon?
Congressman, the findings that we had, the regulatory findings, we were responsive to. And
I'm talking, were the bonuses paid out after you knew after you'd gotten notice the bank had some serious problems?
Congressman, the feedback. that we
It's yes or
received-
no. You know the dates. It's yes or no. Were y'all aware that you were in serious trouble and were the bonuses paid out? And what amounts were paid out?
Congressman, I respectfully disagree with the comment that at that point, the feedback we were in healthy shape. It was the social media led run.
On date-wise, and I got 10 seconds, were the bonuses paid out after you had notice? You were put on a notice that you had a problem at the bank? Yes or no?
Congressman, I don't know
That's
the
a no.
definition of.
You know what you, I yield back.
The witness can answer on the record in writing. The gentlewoman from Michigan, Ms. Tlaib, is now recognized.
Thank you so much. And I really appreciate my colleague from North Carolina, because I think this is going to help answer the question that you refused to answer, Mr. Becker. If you look at the screen, you look at the slide there, it's pretty clear. Just so we're clear, because I know you're blaming social media. You're actually somebody that's blaming. You're not looking at me, Mr. Becker. I'm right here. Yeah. You're blaming social media for your mismanagement and so forth, which to me clearly looks like greed. Because you're not stupid. You're just being greedy because you wanted to get a payout. Just so we're clear for the record, were you aware of any material or non-public information such as the potential capital raise before January 6th trading plan change that allowed you to sell over $3 million in stock, in Silicon Valley Bank stock?
When the plan was set up, I was not aware.
On January 26th, you changed a corporate trading plan, allowing the future sale of your shares in the company, correct?
On that date,
January 26th.
I filed a 10b5-1 plan that was signed off on by our legal team.
Okay, so it's yes. So again, the question, were you aware of any material non-public information, such as the potential capital raise before January 6th trading plan change that allowed you to sell over $3 million in Silicon Valley Bank stock?
When that plan was set up, I was not aware of the plan to raise capital.
So, Mr. Becker, given the federal funds rate increased more than 3% points during 2022, why did your company unwind these swaps, exposing your firm to further rate increases? Because everybody wants to know the answer to the why.
Congresswoman, as mentioned earlier, the decision around our interest rate hedges was made or overseen by our Asset Liability Committee and executed by our Treasury team.
Given the interest rates continue to rise under your leadership, until the collapse, did you feel that terminating these swaps were safe and sound practice?
Congresswoman, as mentioned, I was not involved in those decisions.
Yep, you didn't, and you still got paid? They paid you to not know any of this? Like, what did you do? As the lead person that you're just like, I didn't know, I don't know. Like, you got millions of dollars to not know anything about your own bank? Given your incentive compensation plan, Mr. Becker, I mean, the Financial Times reported that the interest rate swap sales resulted in a gain of $500 million for Silicon Valley Bank in the first 2 quarters of 2022 alone. Given your incentive compensation plan and other forms of pay, did you benefit from terminating its hedges against interest rates?
Congresswoman, if I could clarify 2 points.
Did you get money for it? Did you benefit from that decision?
Congresswoman, can I clarify the point that you're making?
Sure.
So the hedges are, when hedges are changed, sold, the benefit, if there is a benefit, it's actually amortized over several years. That was not taken into income that period of time. And secondly, our compensation committee would actually review anything that they believed was an anomaly outside of our standard practices and back that out typically from incentive compensation.
But Mr. Becker, do you think selling the hedges to interest rate risk is ultimately good for your depositors, shareholders, and other financials in our own financial system in the country as a whole? Was it just good for you, or was it for the executives at Silicon Valley that benefit from the sales through your incentive-based compensation? Because according to this timeline, it looked like you set it up so you all benefit and walked away, while every other bank in our financial system was literally like a jeopardy.
Congresswoman, our compensation was set up for long-term incentives.
You knew. You know you knew. You knew a couple years. You know, even if we increase regulation, they sent you notices, they met with you guys. What do you want them to do, come arrest you and so you can respond to the fact that they saw that you guys were making really, really terrible terrible decisions? I mean, I love that GAO calls it poor governance and mismanagement. You were awful at your job, obviously, right? But at the end, you benefited while the small business community in the country hurt. You know what that looks like when I go back to my community and they're like wondering why we can't claw back the fact that you benefited while everybody else suffered. I mean, do you care that you even would have collapsed the financial system in our country with your greed?
Gentlewoman's time has expired. Next, we'll go to the gentleman from Tennessee, Mr. Ogles. He's recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you all for being here. I'm sure you're aware, or if you're not, we had the FDIC and the Federal Reserve, amongst others, in here yesterday. And although they acknowledge that they probably could or should have done more, they point the finger at you and your failings and your management. So, Mr. Becker, how forceful was the Fed in emphasizing the heightened interest rate risk that resulted from the shift from the COVID era's quantitative easing to an environment with rapidly increasing interest rates?
Congressman, the Federal Reserve was, we covered a lot of different areas. So we were responsive to the feedback that we received, including areas around liquidity, governance, controls, and the MRIA or MRA that we received with interest rate risk modeling.
Well, the reason why I bring that up is because from the start of the pandemic to when SVB collapsed, the Fed didn't mention interest rate risk in any of its reports to Congress. Were you aware that the Federal Reserve had to suspend its remittances to the Treasury last October because it took similar losses to you or your bank?
I was not aware of that, Congressman.
Well, I find it curious that the Federal Reserve, having experienced its own losses, did not recognize or realize the 5-alarm fire it had created. Mr. Shea, Mr. Roffler, how forceful was the FDIC in emphasizing interest rate risks as the priority in the supervision of your banks? Mr. Shea?
I met with the regulators as chairman of the board, so I can't speak for their communications, all of their communications with the bank.
Roffler?
Maybe just a couple of points. First of all, I think in Chairman Grumer's written testimony yesterday, he commented that the failure of First Republic was largely contagion effect driven, and he did not speak to management. I would add that I know several of comments have made about Camel's ratings and things of that nature. That is kind of confidential supervisory information that has not been made public. I do think that the committee might be interested in that information and could make that request, I believe, of the FDIC in the state of California, which would shine a different picture as it pertains to First Republic. And lastly, I would say that, as I mentioned earlier, we had constant examinations. The FDIC in the state of California were on-premise regulators for 6 or 7 years. They looked at a variety of topics: credit risk, interest rate risk, liquidity risk. And when they provided supervisory recommendations, to the extent they did, management worked to address them in an extremely timely manner.
Yes, sir. Now, Mr. Becker, I understand, your comments earlier. You talked about your business model, which was, I guess compared to maybe community banks, had a riskier portfolio, if you will. But understanding that there was a shifting interest rate environment, why wasn't there more priority put on hedging against interest rates in the event, however unlikely it might occur, as part of your again, if you have a 401k, you're going to decide how much exposure you're going to want to market volatility versus against your fiduciary responsibility. And of course, part of this is perspective, but when I look at some of the wokeism that had kind of swept into SVB, it seems like, and again, this is perception, I'm not saying it's fact, is that there was more focus on being woke than there was your fiduciary responsibility. And when I look at your exposure, when I look at the fact that in Econ 101, when the government puts more money into the economy can produce, there's going to be inflation risk on the backside. You don't have to be an economist to understand that. Anyone who's experienced in the markets is going to know there's going to be an upside risk there of inflation, and yet your bank, and again, the Fed and the Federal Reserve are pointing the finger at you guys, are saying that you should have done more. Why wasn't the main focus and priority as you move forward?
Congressman, 2 points. One is, I think it's important to note that the structure of our balance sheet, especially on the asset side, the loan portfolio was 90% variable rate, meaning as rates went up, we would have benefited from higher rates.
And if I may, I am out of time. I want to thank you all for being here. If you wouldn't mind submitting your answer in writing. And Mr. Chairman, I'm out of time. I yield back. Thank you. Thank you, gentlemen.
Mr. Chair, I have a parliamentary inquiry.
Ranking member is recognized for your inquiry.
Thank you very much. My understanding is that joint subcommittee hearings are not contemplated anywhere in the House or committee rules, and therefore can only happen with unanimous consent. Can you confirm that this is your understanding?
It is.
Thank you. So I wish to share with you that I've made clear my concerns about this hearing happening at the subcommittee level to Chair McHenry, because it is very important for all of the members of this committee to have the opportunity to participate in a hearing like this. And I want to be clear that although I have withheld my objections this time, going forward, we will not hesitate to object if this kind of coordination does not occur in advance. Thank you. With that, I yield back.
So responding to the ranking member, I would say the chair and the ranking member both called for this hearing on March 29th. The first time the Federal Reserve and the FDIC testified before the committee. In your opening remarks, the ranking member stated, we also need answers from the CEOs who not only ran these banks into the ground, but enriched themselves. Separately,
Mr. Chair.
Well, separately, let me.
That is not correct.
Can I just?
I asked for a hearing of the full committee, not at the subcommittee level. Make that clear.
Very good. Separately, I would just remind the ranking member that on May 3rd, that you wrote to the chairman asking him to immediately schedule and invite the CEOs in the SVB, Signature, and First Republic execs to testify. This hearing responds to those requests, which was noticed last week pursuant to committee rules.
At the full committee level, Mr.
And I would also just add that if there is concern, the full committee is not holding this hearing. There shouldn't be, because the chairman of the full committee empowered the two subcommittees with the most experience in banking issues and conducting oversight, that the financial institutions and the monetary policy subcommittee and the oversight and investigation subcommittee were allowed to hold this hearing. So in fact, the chairman told the subcommittee chairs at the beginning of this Congress he wanted the bulk of this committee's work to be done at the subcommittee level. To that point, since March 10th, both Mr. Huizenga and I, the chairman, have sent 8 letters to state and federal regulators as well as the IG.
Mr. Chair, in a continuation of my parliamentary inquiry, you must admit, and I think the chair will admit, that my request for holding this hearing was at the full committee level. And of course, you're not implying that the expertise does not exist at the full committee level when you identify that it has been held at the subcommittee level because of the expertise. Mr. Chair, I'm finished with it, and I said to you that despite the fact I did not object this time, I will not allow it to happen again without objecting. I yield back.
Thank you for yielding back. I think a conversation with Chairman McHenry would be valuable. And now we're going to recognize the lady from Texas, Ms. Garcia. Are you ready? Okay, you're yielding?
No, she does not have to yield. As a matter of fact, my time, I am next to be recognized, and the inquiry was just a preliminary to my time to raise the question.
Okay, the ranking member is recognized for 5 minutes.
Thank you very much, Mr. Chair. So, I am interested in learning about all the factors, including bank mismanagement, lobbying efforts to deregulate, and other decisions these executives made that put their customers and our nation's banking system in harm's way. The leadership of these banks must be held accountable for running their banks into the ground. Mr. Becker, it is a fact that your bank experienced rapid growth, doubling in size from 2018 to 2020 and doubling in size again in 2021 alone. Earlier today, in questioning, you suggested that the regulators never discussed the issue of interest rates with you. However, you later acknowledged that the bank was subject to investigations regarding its handling of interest rate risk, and it was cited by the regulators as a problem. In fact, as early as 2018, the Fed had begun citing your bank for poor risk management, including interest rate risk. 4 months before your bank failed in November 2022, the Fed further issued an MRA on interest rate risk. This MRA would have been issued to the bank's board. Is that correct? It would have been issued to the bank's board.
Congresswoman, the regulatory findings are typically issued to management.
Thank you very much. Can you confirm you were on the bank's board November 22?
Yes, I was.
Okay, then you did have access to all of that information. Thank you. So you would have personally received this MRA and all other MRAs and would have had an understanding of interest rate risk, and to say otherwise seems highly misleading. So to me, it looks like you did know what was wrong. I'm also concerned that after the earnings call with investors on January 19th of this year, you amended a 10B-5 plan to sell approximately 12,451 shares of SVB. These shares were sold 2 weeks before you drove the bank into the ground, and you received $3.6 million. Other shareholders in SVB received nothing when the bank failed. Mr. Banker, how is this not a golden parachute you secured for yourself as the bank was failing?
Congresswoman, that sale was part of a 10b5-1 plan that was issued right after our earnings release, reviewed by our legal team, and with my concurrence that I didn't have material non-public information. When SVB was taken over by the FDIC on March 10th, I lost 5 times minimum shares that I was required to hold.
Thank you very much. We have a different opinion about that. I'm going to go to Mr. Shea. You ran one of the well-known crypto banks after Silicon Valley Bank suddenly failed. The market viewed your bank as the weakest link, and depositors quickly began to pull their money. 2 days later, your bank closed. Now, according to the bank failure reports we have received, it seems like your bank didn't even know what collateral it had available that would be eligible to pledge to the Fed in order to obtain emergency loans. Was this the case? Why didn't you know what collateral you had?
My role as chairman, I thought we had collateral available. I thought we had collateral available that was pledged at Federal Home Loan Bank and federal.
Why did you not understand what assets your bank had to pledge is the question, and you didn't. Mr. Walford, J.P. Morgan Chase and 10 other big banks deposited $30 billion in your bank after SVB and Signature Bank failed to rescue your bank. However, in a matter of weeks, your bank failed. What amount would have been sufficient to save the bank? That was $30 billion that 11 banks came together and gave you. What did you need further after that?
We were appreciative of those 11 banks who were helping to reinforce confidence in the regional banking system, which is such an important part of the economy. Unfortunately, First Republic was hit by the contagion of two failures that were occurring. And when the contagion spread to us, it's hard to recover confidence. And by the end of April, investor and depositor confidence had not returned, not for management's efforts and not for everything we did. And again, we had very open and very direct
Thank
communication.
you. My time is over, but no amount of money would have saved your bank. It was mismanagement that caused it to fail. I yield back the balance of it.
Ranking member yields back. I will now recognize myself for 5 minutes. Vice Chair Barr expressed a desire to assess how the Federal Reserve performs analysis on bank mergers. This follows President Biden's call for DOJ and the agencies responsible for banking to update guidelines on banking mergers to provide more robust scrutiny of the mergers. We strongly believe antitrust analysis should be governed by the rule of law and not by the individual views of those who, at any particular point in time, head the relevant agencies. So I'm concerned any change to that analysis that would depart from long existing and widely accepted standards may not reflect actual changes in the competitive environment. A functioning bank system must allow stronger regional banks to be able to acquire those in a weaker position. Mr. Becker, do you believe the current hostile environment towards mergers played a role in your bank's failure?
Congressman, that's not an area of expertise that I have, so I don't know the answer to that question.
Mr. Shea, would you like to respond to that?
I don't think the regulatory merger policy had anything to do with what happened to Signature Bank. I thought we were in a position to continue after the March 12th, March 13th. I thought we had a plan in place, a well-reasoned, solid plan in place that would have brought Signature Bank to exist today and continue to serve its customers without any merger from anyone.
Very good. A November 11th, 2022 Wall Street Journal article explained at length interest rate risks presented to the banking system by the Fed's inflation-fighting rapid increase in interest rates, kind of an article that's been referred to hundreds of times now in this committee. Silicon Valley Bank was mentioned as a particular case with, as of September 30th of 2022, a market value of its held to maturity bonds just slightly above the value of its total equity. So clearly, regulators should have been becoming aware of the risks surrounding Silicon Valley Bank. So back to you, Mr. Becker, if the uninsured depositors had not forced the bank to close with this mini rush, how much longer do you believe the regulators would have allowed Silicon Valley to continue before intervening at all?
Congressman, I don't know what the regulators would have done. I can't speak for them.
Well, let me ask it a little bit different way. Were you working in concert with them, with the regulators? And was there a back and forth with the regulators that would have maybe laid out the case that there are some serious issues emerging related to Silicon Valley Bank?
Congressman, as stated in my written testimony, we were very responsive to the regulatory feedback. Regulators at the FDIC and the Fed and the state.
Okay. The issues with SVB were pretty well known in the days leading up to the failure, right? However, Signature's failure came as a surprise announcement. So to Mr. Shea, at what point was it clear to you that Signature Bank could not last without some type of intervention?
I believed that they had Signature Bank on Friday was sufficiently capitalized. It was well solvent, well diversified. It had a strong securities portfolio and had $29 billion pledged at the Federal Home Loan Bank and Federal Reserve. I fully expected Signature Bank to continue on, and I fully thought that the plan that was presented for financing against the good collateral at Signature Bank would have allowed it to continue open successfully on Monday and be still serving its customers its middle market customers, its customers today?
I will yield back my time and at this time recognize the gentlewoman from Texas, Ms. Garcia. 5 minutes.
Thank you, Mr. Chair, and thank you to the witnesses today. I know we've been talking about trying to have this hearing. Democrats have kept constantly been asking Republicans to bring you down here, and I'm glad you're here, and I'm glad you cooperated and are here with us today, because it's time for accountability. Republicans have been pointing fingers at regulators, but we finally have a chance now to visit with you about your internal workings and your leadership on these failed banks. First, I want to get into some lobbying questions here. Mr. Becker, in 2015, you had lobbied Congress to raise the asset threshold for banks that were considered systematically important. Years later, in 2018, the former twice impeached president had signed S-2155, the Economic Regulatory Relief and Consumer Protection Act, into law, which raised the threshold from $250 to $250 billion, an increase from the previous $50 billion. By this time, Silicon Valley Bank had just reached $50 billion in assets and quickly grew so that by 2022, as been stated earlier, the bank held more than $200 billion in assets. The passage of this law and the way Trump's regulators implemented the law reduced stress, testing, liquidity, and other requirements for banks like Silicon Valley Bank. Mr. Becker, was that your intended goal when you urged Congress to roll back Dodd-Frank's enhanced prudential standards for regional banks, or is it just a coincidence that it was regional banks like yours that failed in rapid succession earlier this year?
Congresswoman, the written testimony that I provided in 2015 was focused on tailored regulation. And what we wanted to do is empower the regulators to make the decisions about risk and be able to then tailor those regulations based on their assessment of the risk profile.
So you don't think that this was just a coincidence that it happened to help your bank and your bank grew as a result of the change in regulations?
Congresswoman, Silicon Valley Bank in 2015 was one of many banks and other institutions or organizations that were talking about tailored regulations.
Okay, Mr. Ruffler, let's talk about First Republic banks. Reportedly, you spent significant sums lobbying Congress under your leadership. In 2018, First Republic spent $370,000 on lobbying. This was reportedly some of the highest lobbying spending in the bank's history. Do you recall what congressional business or legislation might have been of interest to First Republic in 2018?
Thank you, Congresswoman. I was not the CEO at the time. I was at the bank, and there are two topics that came to mind. One is what you referenced before, S-2155, and the other was around tax deductibility around student lending and contributions to student loan forgiveness or student loan repayment plans.
So were your paid lobbyists urging Congress to roll back the Dodd-Frank enhanced prudential standards for regional banks?
I believe they were speaking with Congress about the tailoring rules, as one of the panelists mentioned. And at that time, as I mentioned, I was not the CEO, so I'm not entirely familiar with all of the communications.
Were you at the bank at all?
Excuse me?
Were you at the bank at all?
I was, yes.
So were you not privy to any of the discussions about your lobbying efforts?
Not always, no.
Not always. But it seems to me that you all were lobbying for the changes that may have resulted in some of the failures. But thank you for that response. And now, Mr. Becker, the Federal Reserve stated that it issued multiple supervisory issues to Silicon Valley Bank, including matters requiring attention, and we've talked about those MRAs, and matters requiring immediate attention, MRIAs, which are typically considered to be more urgent issues. Mr. Becker, why didn't the bank take these warnings by the Federal Reserve seriously?
Congresswoman, I can assure you that we took all regulatory findings seriously, regardless of whether they were MRAs or MRIAs.
Well, you might be interested in knowing that when we had the GAO director here, he actually said that many times you all, quote, responded by saying that it would take a while to fix a problem, end quote. What's your response to that? That their analysis was that you all took your time about fixing anything?
So, Congresswoman, it depends upon what regulatory finding it would be. So some of the matters around liquidity were handled very quickly. Others that took systems changes took longer.
The gentlelady's time has expired.
Thank you, Mr. Chairman.
The gentlewoman from Texas, Mrs. De La Cruz, is now recognized.
Thank you, Chairman Barr, for holding this joint hearing today. It's important for all of us to talk about what happened, what kind of oversight needs to be done moving forward, if so, and what led up to these banks failing, and how the responders, how the regulators responded. With that said, I would like to thank the witnesses for coming today. I'm towards the end, and so I want to tell you a little bit about my district. I'm from South Texas. It is largely a Hispanic district, in fact, one of the most Hispanic districts in the entire nation. That being said, we have a large rural community that really depends on regional and small banks. And so as I call the banks in my area, when this was happening, they were worried about bearing the consequences of your bank failures and what that may mean for them in the future. And so with that being said, our friends on the other side of the aisle have called for higher capital requirements and increased regulations due to your bank's failures. What I would like to know from each of you is, do you think that increased regulation and or increased capital would have prevented this crisis? And I'll start with you, Mr. Becker.
Congresswoman, as I laid out in my written testimony, we're here today from my standpoint because of a series of unprecedented events. As far as what are the rules and regulations that could have prevented it, I don't have the answer to that, but I'm hoping my testimony and the other testimony will help us get there.
Signature Bank was well capitalized, solvent, and well diversified at the very end, and had a plan to go forward that I sincerely wish had happened, because I believe we would have been here today. But in response to your question, on that afternoon, in those few hours in the afternoon, in the late afternoon of Friday, depositors who I spoke to simply wanted to get their money in a too big to fail bank. They said they didn't care if there was a 1 in a million chance. They didn't care if there's a 1 in 10 million chance. This was their family money, their family business, their way to make payroll. They couldn't take any chance of not being in a too big to fail bank. And they said, things like JP Morgan they won't let JP Morgan fail. I know they'll save Citibank. And so I don't know what I don't know, but I know that's the challenge.
Yes, sir.
Thank you for the question, Congresswoman. I want to be very clear that I can't speak to what has happened at the couple banks here with us today. But what I can say is that what happened at First Republic was not mismanagement. It was element of contagion. And if you think towards the regulatory side of that, when contagion hits, it's very hard to regulate and call for greater capital, greater liquidity. As I said earlier, we had very strong relationships with our regulators. We shared everything. We met all the time. And we had zero matter requiring board attention at March 9th when the contagion moved towards First Republic. And so I think, to your question, it's very important for the communities that are served to have appropriate regulation to keep them safe and sound, but allow them to serve their clients each and every day.
So that being said, given you all's expertise in banking, how do you think smaller financial institutions, community banks, would be able to cope with increased regulatory burdens?
I think it's a great question, and not one I probably have a great answer for, but I think if policymakers and regulators, invite comment and engagement, I think it's probably the best way to try to do that, and hopefully those banks will engage in that discussion.
Thank you, Mr. Shea.
I would defer to banks who are of that asset size.
Okay. Mr. Becker?
Yeah, I would agree that's something that this committee should pay attention to.
Thank you. And I'm going to ask real quickly, because of what we saw happen, do you all have any suggestions for Congress on how to address the technology of this that we've talked about for so many hours now? Could we do something different on the social media side or address something different? Anybody like to take it? All right, I yield back.
General Lady's time has expired, and the gentlewoman from California, Mrs. Kim, is now recognized.
Thank you, Chairman. I want to thank the chairs and ranking members of this committee for having a joint subcommittee hearing. Since SVB's failure, our committee has been laser focused on getting complete information and helping to prevent similar bank failures from occurring in the future. And there are two main points that stand out from the postmortem reports, and that is bank mismanagement and supervisory failures. Mr. Becker, while I agree with you that the Fed and Treasury Department missed the mark by describing inflation as a transitory risk, I am surprised that you decided to drop most of the interest rate hedges by mid-2022. And this is after the Fed started to increase rates in March 2022. In SVB, by then we already know, we had 31 open supervisory findings and did not have a chief risk officer for most of last year in 2022. So, Mr. Becker, yesterday, you also mentioned that the specific decisions about hedges were executed by the Treasury team. But as CEO, didn't you have the final say on the decision that was executed by SVB's Treasury team?
Congresswoman, the decision on the hedges, I was not privy to. They wouldn't have come to me for approval.
You know, the Wall Street Journal reported you reduced hedges to $563 million. That is down from $15.3 billion just a year earlier.
Congresswoman, as I mentioned, I wasn't part of the Asset Liability Committee, and I have every reason to believe they made the best decisions they could with the information they had at that time.
Do you believe then not having a CRO played a role in the decision to drop the hedges?
To the best of my knowledge, I don't believe so.
Well, Mr. Becker, in early 2023, March of 2023, you sold your available for sale securities at a $1.8 billion loss. You didn't have an immediate need for liquidity, and this sale had a negative impact on your regulatory capital. So why did you make that decision?
Congressman, that decision was made in consultation with our board of directors and outside advisors, and we believe that was the best decision for our clients and for our shareholders.
Those securities were sold to Goldman Sachs, the same investment banking firm that was advising and underwriting your capital raise. So didn't this seem like a conflict of interest? And how did you ensure that you received the best possible price for those securities?
Congressman, Goldman Sachs was our advisor on our capital raise, and the decision to ultimately sell the AFS portfolio to Goldman Sachs was a decision that was reviewed with the board of directors and the special committee of the board. To my memory, they put in place a structure that would be a benefit such that it was to get the best price we could and then validate that in the market.
Okay, well, we're going to move on. Mr. Roeffler, let me ask you a question. The unprecedented speed of withdrawals in the digital era is pushing our committee to rethink the rules, regulations, and the role of the Fed as the lender of last resort. And it's been reported that your firm was one of the banks that used both the 13(3) facility and discount window. Did these lenders of last resort meet your liquidity needs in March? And in your view, what could have been improved?
Thank you for the question, Congresswoman. Yes, on beginning on March 10th, we began to engage with the Federal Reserve Bank of San Francisco and also the Federal Home Loan Bank. We had previously pledged collateral with both of those institutions that we could borrow from. And during the weekend, when the contagion spread to us on that Friday, we continued to prepare that weekend, and actually the Federal Reserve Bank worked with us to ensure our collateral was pledged and we could appropriately access it. And that Monday, we accessed it with no challenge.
Well, thank you. I'm going to come back to you, Mr. Becker. So how many years did you serve on the board of directors at San Francisco Fed?
I believe it was roughly a little more than 4 years.
So as a board of director, did you at any point have any input on the supervisory activities of the San Francisco and any financial institutions, including SVB?
I did not.
Well, could you walk us through the role that you do as a board of director at the San Francisco Fed?
The gentlelady's time has expired, and the witness can submit an answer in writing to that question.
Thank you.
I'd like to thank our first panel of witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions to these witnesses to the chair, which will be forwarded to the witnesses for the response. I would ask that each of you please respond as promptly as you are able. The committee will take a brief recess to let the first panel go and seat the second panel. These witnesses are now dismissed. The committee will stand in recess.
I now call up our second panel of witnesses. Today, we are welcoming the Honorable Adrienne Harris, Superintendent of the New York Department of Financial Services, and Clotilde Hewlett, who is the Commissioner of the California Department of Financial Protection and Innovation. And we thank each of you for taking the time to be here. We're going to be moving right into your testimony. There won't be any opening statements, and you will each be recognized for 5 minutes. So, Ms. Harris, you have 5 minutes.
Thank you. Good afternoon, and thank you to Chairman McHenry, Ranking Member Waters, Chairman Huizenga and Barr, Ranking Members Foster and Green, and members of the subcommittee. I'm Adrienne Harris, Superintendent of the New York State Department of Financial Services, and I thank you for inviting me to this hearing today. On Sunday, March 12th, 2023, Signature Bank failed after experiencing a propulsive run on deposits on Friday, March 10th. The run was instigated by the self-liquidation of Silvergate Bank on March 8th, and then the failure of Silicon Valley Bank on March 10th, following an unprecedented run on its own deposits. In order to avoid a disorderly midday Monday shutdown and further contagion across the banking system, on the evening of Sunday, March 12th, DFS took possession of Signature and appointed the FDIC as receiver. Before its failure on March 12th, regulators had documented liquidity-related regulatory concerns to the bank, beginning with the 2018 report of examination. Despite orders from regulators, the bank was slow to remediate supervisory recommendations, and many issues identified by the regulators remained unresolved when the bank failed. Signature's inability to remediate the outstanding liquidity management issues undoubtedly contributed to its collapse. However, the immediate cause of the bank's failure was an unprecedented run on deposits, instigated by the self-liquidation of Silvergate and the subsequent failure of SVB. On Friday, March 10th, Signature experienced a runoff of $18.6 billion in deposits in a matter of hours, reducing the bank's deposit base by 20%. Throughout the day Friday and into the night, the regulators worked closely with each other and Signature to find sufficient liquidity to satisfy the significant volume of customer withdrawal requests. After avoiding a default on Friday, regulators had time over the weekend to assess Signature's condition and come to a considered view as to whether the bank could open safely on Monday. DFS had one objective that weekend: to preserve the safety and soundness of the banking system. 3 paths were identified for the bank in order of preference. The first was to find a way for Signature to open in a safe and sound manner on Monday and continue as a stable institution. The second was to find a purchaser for the bank on an open bank basis. And third, DFS and the FDIC would work in parallel to prepare for the last resort scenario of taking possession of the bank and appointing FDIC as receiver. The regulators spent the weekend collecting and evaluating information from Signature in order to make a data-driven decision about the bank's viability. Signature's inability to provide reliable data and a credible liquidity strategy to operate in a safe and sound manner on Monday led DFS to take possession of the bank and immediately appoint the FDIC as receiver. At the time DFS took possession, the bank had $4.27 billion of certain liquidity available for Monday morning to cover known withdrawals ranging from $7.4 to $7.9 billion. These withdrawal estimates do not include additional unknown withdrawals that could reasonably be anticipated on Monday in light of market conditions. Taking possession of the bank was the option of last resort to avoid a disorderly midday Monday shutdown and stop any further panic and contagion across the broader banking system. DFS-regulated financial institutions are safe and sound today, but the department has instituted heightened monitoring of banks with higher risk profiles and is implementing recommendations to modernize supervision of the global financial system. Thank you, and I look forward to your questions.
Thank you, and you yield back the rest of your time. I should have added this, excuse me, that without objection, each of your written statements will be made part of our permanent record. So thank you, Superintendent Harris. And with that, Commissioner Hewitt, you are recognized for 5 minutes as well.
Chairman, Ranking Member, and members of the committee, I appreciate the opportunity to testify on behalf of the California Department of Financial Protection and Innovation. My name is Clotilde Hewlett. I've served as commissioner since December of 2021, building on over 100 years of state regulation. The current department was restructured in 2020 to strengthen California's financial oversight. DFPI has broad authority touching every aspect of the financial sector in California, including banks and credit unions. Through regulation, supervision, and enforcement, DFPI promotes safety and soundness and consumer protection. State-chartered banks like Silicon Valley Bank are regulated by both state and federal regulators. State regulators play a vital role in maintaining the strength of the dual banking system, particularly for local banks that serve diverse communities throughout the country. State regulators supervise almost 80% of all the banks in the U.S., which equates to more than 3,800 banks and $8.5 trillion in assets. This includes overseeing 2/3 of agricultural lending and half of small business lending. The localized supervision equips state regulators to better understand the unique demands forced by banks in local communities. In California, DFPI supervises 99 state-chartered banks with an average asset size of approximately $4 billion, nearly half are $1 billion in assets, and 9 of our banks are over $10 billion. The department also supervises 113 credit unions with an average asset size of $1.4 billion. For nearly 40 years, Silicon Valley Bank was an important service provider for California's tech economy, the life sciences and healthcare sector, nonprofits, and small businesses. On March 8th, the bank announced a loss of $1.8 billion and a capital rise. Depositors reacted by initiating withdrawals of $42 billion, or approximately 25% of total deposits, over a 24-hour period, causing an unprecedented run on the bank. At the end of March 9th, the bank had a negative cash balance of approximately $958 million. We determined that the bank was insolvent. On March 10th, the DFPI took possession of the bank and appointed the FDIC as receiver. The DFPI examined the bank in coordination with the primary federal regulator, the San Francisco Reserve Bank. Federal examiners led the examination of Silicon Valley's compliance with federal regulations related to enhanced prudential standards and the review of SVB's liquidity and interest rate risk. The department and SFed flagged concerns about the bank's liquidity management beginning in 2021 and interest rate risks beginning in 2022. Though it is typical to provide time to remediate, the timelines were not acceptable. The department has conducted and published an internal review of the supervision and the closure of Silicon Valley Bank. That review and the recent failure of First Republic Bank highlight the need to make changes to promote the safety and soundness of state-chartered banks. The DFPI is committed to working with federal regulators to develop stronger and more effective systems to promptly remediate deficiencies and better allocate staff according to risks. The DFPI will increase its focus on banks' level of uninsured deposits and require banks to evaluate and account for emerging risks posed by technology-enabled activities such as social media and real-time withdrawals. I look forward to working with Congress, our federal regulatory partners, and California's state legislature to implement changes that strengthen our financial system. Thank you very much.
Thank you, Commissioner Hewitt. I appreciate that. And we will now turn to member questions, and I will recognize myself for 5 minutes. And I do want to thank you both for being here. This is an important part of the examination that we have. Commissioner Hewitt, your report states that the Federal Reserve was the leading regulator on interest rate risk due to its expertise. Your November of 2022 supervisory letter concluded that SVB's interest rate risk simulations were not reliable. Did you or the Fed identify concerns with interest rate risk prior to November of 2022, or was that the first time that it was officially raised?
Liquidity risks were identified in 2021 in a November supervisory letter. In May 31st of 2022, corporate governance deficiencies were identified, as well as you have noted, in November. But in August 17th, 2022, there were numerous MRAs and MRIs noted, and in addition, Silicon Valley Bank board management was notified that an MOU would be initiated.
So just to be clear, you're saying that in November of 21, there was official notification from the Federal Reserve about their concerns with interest rate risk mitigation.
It was more of liquidity risk management we found to be
so not necessarily tied to the interest rate risk.
Yes, the interest rates were not identified until the LFB, the Large Foreign Bank Organization team, began their review, and that was noted in the November 15th, 2022 letter.
I will note that in testimony earlier today, the former head of SVB said that there had not been any of the interest rate risk brought up officially or informally by the Fed until that November of 2022. During the 2021 and 2022 examination cycles, DFPI collaborated with the Federal Reserve of San Francisco on 10 out of the 16 targeted exams. Aside from the horizontal reviews, DFPI did not participate in the liquidity review, a capital review, and model risk management review. Why wouldn't a state regulator, I'm a former state legislator myself, why wouldn't a state regulator want to participate in a liquidity review on one of its largest state chartered banks?
We had two examiners that were assigned full-time. There was a decision based upon the fact that the federal regulators had 20 highly trained examiners at that time were in the best position to conduct the review, but we worked in consensus, in collaboration, and agreed with the results.
But that was your decision? Or did the Fed say, hey, we have the expertise, let us handle this?
That was the decision that was made by DFPI.
Okay. And then you had this supervisory letter in August of 2022. The letter explained regulators' plans to initiate an informal enforcement action in the form of a memorandum of understanding, an MOU, with the bank. However, as of March of 2023, the failure of SVB, the MOU is still in the drafting process. What was DFPI's role in drafting the MOU, and was it primarily the Fed, or was it you driving that MOU that had been in draft form for 6 months?
We worked in collaboration with our federal partners in the drafting of the MOU. However, there was a consensus decision that was made by DFPI in working with our federal partners to wait for the MOU until after the liquidity risk and horizontal review was completed. We could have and should have, looking back in hindsight, issued an MOU in August of 2022 when we had noted numerous deficiencies and had indicated that there were numerous MRAs and MRIAs open.
My time has expired, and we will be following up in writing because I'd like to unpack more of that particular issue as to why that was not done. With that, the gentleman, the minority ranking member from Texas, Mr. Green, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I'd like to make an observation. Obviously, it's a part of my time, but as you know, I have been very critical of our not having gender balance on our panels. Usually we have white men, and I want to compliment you today. We have 2 women on a panel. I think that if I'm going to be critical when appropriate, I should also be complimentary when appropriate.
If the gentleman doesn't mind making an observation, I'll suspend the clock. In our last few O&I hearings, we did have African-American woman and 3 Hispanics. The Democrat witness was actually a white female professor. So we've been trying very hard to make sure that we've got everybody having a voice at that table. I yield back.
Thank you. Thank you very much. And it means something to me, given my history and the history of my ancestors, to see this occur. So much to be said, but let's get back to the business at hand. Superintendent Harris, you indicate on page 5 of your written statement, and you said so much verbally as well, that the management of, we're talking about Signature, while acknowledging regulatory findings, did not heed the regulator's orders. The bank was slow to remediate supervisory recommendations, and many issues identified by the regulators remained unresolved when the bank failed. You go on to indicate, however, that the immediate cause of the bank's failure was an unprecedented run on deposits instigated by self-liquidation of Silvergate Bank and the subsequent failure of SVB. This indication that the supervisory remediations identified remain unresolved when the bank failed. While I do think that this is very important, there is a belief by some that the supervisors, the regulators, they were not severe enough with their punishment, and that this lack of severity is the reason that the banks failed to do that which they should have done. Would you comment on this, please? And I don't want to pull you into a real tug of war that's going on here, but I'll ask if you could to give a commentary.
Sure. Thank you so much, Congressman. First, I will say, although the immediate cause of the failure was the propulsive run and the self-liquidation of Silvergate and then the failure of SVB, of course, that's no excuse for the bank not remediating the MRBAs, the SRs in a timely fashion. What I will say is that in addition to bank management being more responsive, more accountable, I think we also need regulators to act more quickly. Since I've taken my seat 19 months ago, we've worked to update our supervisory procedures and, of course, in light of these failures, to make sure the feedback loop is faster and tighter so that the examination process can take place more quickly, feedback can be given to bank management, and we are reviewing our procedures at DFS to make sure recidivist bad activity is escalated more quickly so that we can take more prompt action.
We've had the Government Accountability Office, as well as the prudential regulators, to indicate that at the end of the day, the failure of the banks lies with them, that the regulators don't create circumstances that cause failures. I see you nodding, but is that a fair statement?
I think that's a fair statement, but as flagged in all of the reports, I think there is improvement that regulators can make as well.
I agree that we can all make improvements, but as you know, it's the bank that has the liability.
Yes.
The regulators don't have liability, and the banks have the duty, responsibility, and the obligation to have a good risk management team. And the banks, in the final analysis, are charged with any failure. But let's go on to the next brilliant panelist that we have. You note that I said next, connoting that both are brilliant. Would you just tell me quickly, do you believe that the bank's failure was due to the regulators not being severe enough with their MRs?
I think that there were many factors, not just one, that led to this bank's failure.
Yep, sorry, the time has expired, and we are gonna have to have you respond for the rest of that for the record in writing. So thank you for that, appreciate that. With that, the gentleman, the chairman of the Financial Institutions Subcommittee, Mr. Barr of Kentucky, is recognized for 5 minutes.
Thank you, Mr. Chairman. Superintendent Harris, was Signature Bank well capitalized at the time of its failure?
They were well capitalized, but they had inadequate liquidity risk management and other risk management practices.
Did your agency issue an MRA or an MRIA, or to your knowledge, did the FDIC issue an MRA or an MRIA related to Signature's capital adequacy?
Yes, sir, and of course our MRIAs, our supervisory recommendations, are done jointly, so DFS and the FDIC together.
But were any of those MRAs related to capital?
Yes, they were.
Explain that. If it was well capitalized, why issue a matter requiring attention?
Because there's always room for improvement and better risk management practices that can be.
Well, let me ask the question this way. Did the FDIC ever raise concerns about Signature's capital adequacy?
Ever? Yes, I believe we both did.
What was inadequate about those capital levels? Did they not satisfy existing regulatory requirements?
I think the concerns centered around the types of capital, the ability of the bank to find appropriate liquidity to manage that risk, given the risk profile of the bank and the growth of the bank over a short period of time.
Would increased capital have saved Signature?
I think it's hard to speculate. Congressman, I think there's mismanagement on liquidity risk management, interest rate risk management, governance, and other factors.
So not as much of a capital adequacy issue as these other issues, liquidity and interest rate sensitivity.
I think it's hard to disentangle them, but yes, I think liquidity issues were.
Let me ask you, Commissioner Hewlett, was SVB well capitalized?
At the time of its actual failure, it was insolvent. Prior to the actual failure.
Before the run. Before the run, was it well capitalized?
Before the run itself occurred, it was considered in traditional terms well capitalized.
Yeah, in fact, reclaiming my time, in the prior 4 years, Silicon Valley Bank Tier 1 Common Capital Ratio was similar or higher than the average of its peer banks. It was well above the applicable capital threshold set by regulators. Would increased capital requirements have saved Silicon Valley Bank, given a $42 billion run on deposits in 2 hours?
Once the run began, I don't think anything could have addressed.
So here's the point. These bank failures did not involve a capital adequacy issue. Is there any evidence that these banks failed due to inadequate levels of capital? And I think the answer to that is no. Did the Fed or the FDIC raise concern with you, as you all did joint exams, related to asset liability mismatches on the balance sheet of these banks?
That was one of the areas flagged in several reports, but not to the extent of liquidity and other risk management issues.
Commissioner Hewlett, the Fed's recent report on Silicon Valley Bank's failure lays blame on senior management at the bank. Indeed, the Fed states that Silicon Valley Bank had 31 unaddressed safety and soundness supervisory warnings. It's my understanding, however, that the senior management team had acknowledged each outstanding warning and set forth plans for remedial action. Ms. Hewlett, how did your supervisors ever allow the bank to reach 31 unaddressed warnings to begin with. Why didn't you or the Fed ever stop and think, with all these warnings, there's clearly a larger issue here?
We operated in consensus with our federal partners, and it was unacceptable that we did not operate in a timely manner. However, most of our banks are smaller community banks, and our state bank regulators work with our smaller community banks to give them time to remediate their deficiencies.
Well, I think that may provide your agency with an excuse, but certainly not the San Francisco Fed. Ms. Harris, final question to you. Following the collapse of SVB, Signature had to tap the Federal Home Loan Bank of New York. You state in your report that that's because they didn't have the collateral to pledge to the New York Fed. However, it's been reported that Signature had additional borrowing capacity with the New York Federal Home Loan Bank, but when the New York Federal Home Loan Bank attempted to transfer that collateral to the New York Fed, they refused to accept it. Could you please elaborate?
We had some operational challenges that we can respond more to in writing, but in short, we had to have the Federal Home Loan Bank subordinate its interest in the collateral that had been pledged to the Fed in order to get sufficient liquidity for the bank on the Friday.
I yield back.
Gentleman's time has expired. With that, the gentleman from California, Mr. Sherman, is now recognized for 5 minutes.
I want to focus on this idea that these banks were well capitalized. There are a lot of countries around the world that have what are termed zombie banks. They're undercapitalized in terms of what their assets are really worth. But their bank regulators, and for this or that political reason around the country, says they're well capitalized by allowing them to list those assets on their balance sheet at far more than they're worth. I fear that we do the same here in our country, although it's a little less obvious. You can say Silicon Valley Bank was well capitalized. That is to say, its assets were worth a lot more than its liabilities. But the fact is, when it was taken over, FDIC had to pay $20 billion to somebody to take it over. So in fact, the liabilities exceeded the assets by at least $20 billion. Another $2.5 billion in Signature, another 13 for First Republic, all of them underwater. Assets not worth. And the reason for that, in this case, was that when interest rates go up, the value of your loan or your bond goes down. That's interest rate risk. And we have a system of disguising that at the regulatory level and at the and at the bank at the financial accounting level. So, Ms. Harris, if you have a bank that says it's got $20 billion in capital, but you actually look at the securities that they bought, and they've lost $19 billion. They're worth, in today's market, $19 billion less. Is that a well-capitalized bank, or is that a bank barely holding on with, they had $20 billion in capital, but they lost $19 billion?
Yeah, sir, I think revisiting the accounting rules and assumptions is well warranted in the case of what we've seen in recent months.
Now, I said this to Mr. Barr when he was here. You folks have come up with advice that you give in the bank, but then they didn't take it. I used to be a business consultant, and I would give advice, and they wouldn't take it, and they'd pay me, and I was happy. Why, when you saw these problems, how come you didn't require the banks to use credit default swaps to ensure their position, or to sell their long-term securities and buy short-term securities? Why were they allowed to ignore your good advice? I'll ask first, Ms. Hewitt.
First, regulators' responsibility is to promote safety and soundness and to identify deficiencies to board management. It is board management's responsibility to operate that bank.
And when they don't take your advice, do you pull the plug or just shrug your shoulders and walk away?
When they don't take our advice, we should move aggressively and swiftly with increased measures, even if it means a cease and desist or consent decree.
I want to focus on one other thing, and that is we're the only country in the world, I believe, with this kind of bizarre system of overlapping regulatory authorities. You can choose to be Fed, you can go with the OCC, and let's say, Ms. Harris, your institution was really tough on banks. Couldn't they escape you by either chartering themselves in New Jersey or going with going with Fed regulation? And if several banks did that, you'd lose revenue, you'd have fewer people to audit, your institution would decline. Is that what happens to a bank regulator who is tougher than the Fed regulators or the regulators in adjoining states?
I will tell you, we don't take those sort of things into account. We address risks at our institutions as we see fit, whether it's banks, insurance companies, or the virtual currency companies we regulate. The rules are the rules.
I would hope so, but in this case, the rule tended to be we see the problem, but we don't force the solution. Ms. Hewitt, you described your the folks you audit as being in that kind of $1 to $2 billion range, community banks, community credit unions. Does it make sense to have your agency do a $200 billion organization like the Silicon Valley Bank?
Sorry, the gentleman's time has expired. So
please respond for the record.
Yeah, we'll respond on the record. So with that, the gentleman from Missouri, Mr. Lukemeyer, who is also the chair of the Subcommittee on National Security, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Welcome to our guests today. Ms. Harris, Ms. Hewlett just made the comment that when banks are misbehaving, that in order to be able to make your point, sometimes you have to do things a little more aggressively to take over and do stuff. Do you agree with that?
Yes, I do.
So the question, that begs the question then, in the GAO report that with regards to this, just came out last week, matter of fact, the FDIC, with regards to Signature Bank, made the statement that Signature Bank's management failed to take adequate steps to mitigate the bank's long-standing liquidity and management issues before the bank's failure. They added that Signature Bank's management would report to the FDIC that it mitigated an issue only for the FDIC staff to find the issue unresolved during transaction testing. Behavior caused FDIC to issue repeated supervisory recommendations to Signature Bank. Were you aware of this?
Absolutely. We regulated the bank jointly, and you'll note DFS is a co-signatory on every supervisory recommendation and report of examination.
What were you not doing then to force the action if the FDIC was doing nothing and you agree that something needs to be done? Why were you not doing something to be more aggressive, as you agreed with the statement of Ms. Hewlett here, to get things done?
Yes, sir. Well, since I've come into my seat over the last 19 months, we've worked to update our protocols.
That's not my question. My question is, why didn't you do something?
Sir, when I came into my seat, we were in the middle of an exam report, but assuredly we would have taken swifter action had that exam been able to conclude.
In the middle of an exam report, that's not answering my question either. I ask you, why didn't you take action? You just agree with that. When you have somebody not doing their job, you need to be more aggressive. Why do you not take more aggressive action?
And as I noted, we were
Was
in
it
the
a
middle
failure of your examiners to do their job? That's my question.
No, sir. We identified the issues. The bank management failed.
Well, that's fine. You identified the issue, but now you got to do something about it.
I agree, sir, and we are working to escalate issues and take swifter action.
So you didn't do anything about it. So you guys were incompetent as the guys managing the banks. That's the problem. You guys didn't do your job. I used to be a bank examiner for the state of Missouri. I know what my job is, and you guys didn't do yours. That's the bottom line. Ms. Harris, interest rate risk is a real problem, and a lot of the banks are upside down right now, got some liquidity problems. Even the Fed itself is upside down. Had Chairman Powell here the other day, he admitted his bank, his Federal Reserve, losing money because he's got himself upside down on his rates. Did the Fed ever discuss with you the potential liquidity shortage due to rate hikes with the two banks there in California?
Discuss with me or discuss with my colleague from California? Sorry.
Ms. Hewitt. She's from California, right? Yeah.
Yes.
Okay. You oversaw those two banks, right?
So,
So did FDIC or the Federal Reserve, either one, discuss with you the interest rate problem that those two banks presented?
the Federal Reserve did discuss that there were deficiencies in terms of the review of Silicon Valley Bank's risk due to the rising interest rates, and that their simulations were unreliable. And they also discussed it with Silicon Valley's bank management in November of 2022.
Did they offer to work with you and in conjunction to do something with this, to force some action by the bank to take some action here?
They were going to take some action along with us, and Silicon Valley Bank management was informed as a result of their failure in this area and their lack of sensitivity to interest rate risk, that an MOU was going to be issued, but the bank run occurred prior.
I got to listen in a minute. I'm sorry to interrupt, but I got to listen in a minute. I got one more issue I want to talk to you about. I think this is a very teachable moment for all of us. Standpoint, the social media helped drive this situation. This morning, the gentleman indicated how long it took for them to lose all these dollars out of these deposits out of their bank. Social media has really turned our banking world upside down with how quickly things can happen. I think that there's a national security risk here from the Chinese watching what's going on right now. We're self-imploding, and I'm very concerned about it. Do you have the same concerns?
Yes, sir.
Ms. Hare?
Yes, definitely.
We want to continue to work with, I see my time is out, but we want to work with you to be able to try and address this. To me, this is the newest challenge that this industry has. With real-time payments around the corner, we've got to figure out how to make sure that we can transfer money safely and not endanger the entire system. Thank you very much. Back to the chairman.
Gentleman's time has expired. The gentlewoman from Ohio, Ms. Beatty, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, ranking members. And thank you to our witnesses here today. Superintendent Harris, earlier today on panel one, we had Mr. Shea here, co-founder of Signature Bank, and he indicated that he didn't think it was necessary for the regulators to close Signature Bank. Can you address his claim and explain the decision to close the bank that weekend in March?
Absolutely, ma'am. As under my authorities in banking law, section 606 of New York, I have the authority to take possession of a bank if it's operating in an unsafe and unsound manner, or if it's operating in an unauthorized manner. In this case, we knew the bank had at least a $4 billion shortfall at the time we took it over. They had an inability to demonstrate a credible liquidity strategy, and I'll give you one example, which is on Saturday afternoon, they said to us that they had $5.1 billion in pledgeable securities, and 35 minutes later, they revised that estimate down to just $900 million. The regulator's inability to get a clear and credible liquidity plan from the bank made it clear that they would not be able to open in a safe and sound manner on Monday.
So I'll ask you the question we asked him, to whose fault is this? And maybe kind of follow up to my colleague's question. So Mr. Becker was the only one who said, or halfway acknowledged and took responsibility as being the president. So do you think it was Mr. Shea's fault? Do you think it was also your fault?
I think that primarily bank management failed to put the risk management
And who is
in
bank
place.
management?
Mr. Shea and his colleagues who were running the bank both at the executive level and on the board. And I think there are areas for regulators to improve as well.
Okay. Let me go to my next question. I'll ask both of you. I can start with you, Commissioner Hewlett. I'm concerned that without deposit insurance reform, that we may continue to see an outflow of bank deposits away from smaller banks and into the nation's largest banks. Community banks, as you probably will agree, are the backbone of our local communities. And we saw how they pulled through to support communities during the pandemic, for example, by ensuring that small businesses could get access to the Paycheck Protection Plan, or PPP. We had some difficulties at first, as you'll recall, and had to come back, and many of us, especially on this side of the aisle, had to make sure that we were dealing with small businesses. So here's where I'm going. There are 193 community banks in Ohio. That's my state district, with a combined $134 billion in assets. Almost 80% of these banks have been in businesses for over 100 years. As a comparison, Silicon Valley Bank had over $212 billion in assets. Do you share my concerns? How are these community banks in your state going to do after the aftermath of this recent bank failure? And do you have any recommendations for us?
Yes, first and foremost, regardless of what federal legislation is introduced and passed, I think there must be emphasis placed upon supporting our community banks. Our community banks are on the front lines providing lending to our small businesses, which are the engine of our country. Our community banks are the entities that are providing lending to our most underserved, whether they be in inner cities or rural America. So whatever solution we discuss or collaborate with together, our community banks should not bear the burden, and everything possible should be done to support them.
Okay, and I'm going to ask you the same question. Do you think when we talk about the bank presidents were here, whose fault was it that this happened?
I don't think there was just one factor. I think there was a combination of factors. I think there was deficiencies in governance and management. There were deficiencies in the board management and taking into consideration all the different types of liquidity and capital risk.
Do you think it was regulators' fault as well?
I believe that the regulators did not act in a timely fashion, and we take responsibility for that. That combined with the impact of social media and how fast one can withdraw their money through digital platforms, I believe all those factors.
I'm sorry, but my time is up, but thank you for your response.
Thank you, gentleladies. Time has expired. With that, the gentleman from Texas, the chair of the Small Business Committee, Mr. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Thank the witnesses for being here today. In the California DFPI's internal review report on their supervision of Silicon Valley Bank, it states that there was a staffing shortage with only 2 examiners supervising SVB. The report goes on to say that SVB had already failed by the time additional examiners were available. And the report also indicates that the agency failed to act when an examiner in charge elevated need for additional resources to review SVB's materials in 2021 and 2022. So California DFPI proposed budget for 2022 through 2023 was $157 million. Now that, I'm from Texas, that's a lot of money in Texas, okay? And a sum that large would be adequate to keep a full-time supervisory staff up and running. So I'm curious as to what the California DFPI prioritized allocating resources towards. So Commissioner Hewlett, what was that money used for, and if not for an adequate number of supervisors?
Well, going forward, we have taken our existing resources and we have added more staff to our examination team as it relates to large banks. We have put in a very strengthened early module system and mandated a large supervisory plan with emphasis on looking at uninsured depositors, particularly in a particular sector. And we have tightened our adherence to timelines to ensure that our banks moving forward, our large banks, remediate in a timely manner.
So let me follow through. Did a similar staffing issue occur at any of the 8 other banks that DFPI oversees, or was it just this one?
There were staffing issues which we have now addressed and created an enhanced monitoring team as well as a large supervisory plan for large banks.
Sounds like there's a lot of people involved now.
Since 2019, Signature Bank had retained a less than satisfactory rating in liquidity. And in the reports that were released, it was stated that the Signature Bank was warned multiple times by regulators of their risks. And even though the bank was aware of these risks, they left many of these weaknesses unresolved. I think we've talked a little bit about that. So again, Superintendent Harris, in your testimony, you said that Signature's failure to remediate the outstanding liquidity management issues undoubtedly contributed to its collapse. And so why was there no action taken when you'd already downgraded Signature's liquidity and management ratings? And how often do you downgrade to the lowest level, and how did that not signal a potential bank collapse?
Sir, as we've noted, the regulators, including DFS, should have taken more swift and prompt action to force the bank to remediate those items that had been flagged year after year and that were left open.
This has been an expensive learning experience, hasn't it, for everybody? So again, Commissioner Hewlett, Silicon Valley Bank was without a chief risk officer for 8 months. We've talked about that. And in the DFPI's report, it indicates that the circumstances of the role of the chief risk officer at SVB was unknown. He was there, but he didn't know what he was supposed to do. And I know that in that report, he says issues with risk management, the board's failure to hold a senior management accountable for risk management plans were the basis for the MRAs and ratings downgrades. So lastly, Commissioner Hewlett, when the DFPI issued the MRAs, were you aware of the status of the chief risk officer, or did you expect Silicon Valley Bank to provide those updates for you?
We should have moved in a much more aggressive and timely fashion to make Silicon Valley Bank address their deficiencies.
All right, and lastly, given the interest rate risk was a major factor in SVB's failure, should these have been elevated to a matter requiring immediate attention?
In terms of the interest rate risk, they were elevated. An MOU was in the process of being initiated. However, before the MOU was initiated, the bank run had begun.
Okay. Usually you hear about more people than you needed with the government. Now we've got too few. So I'd leave my...
Gentleman yields back. Gentleman from Illinois, Mr. Caston, is recognized for 5 minutes.
Thank you, Mr. Chairman. Commissioner Hewlett, I'd like to start with you. We had a couple hours ago, Greg Becker told us that he was not aware of any discussion of interest rate risks at SVB prior to early 2023. I think you just mentioned in your conversation with Chairman Huizenga that I think you said November 22, you were raising concerns. And in a Washington Post article called Silicon Valley Bank's risk model flashed red, so its executives changed it. It says that Silicon Valley Bank purposely changed their assumptions about interest rate risks to hide interest rate mismanagement, maximize short-term profits, and says that, quote, changing assumptions about interest rate risks were shared with federal and state regulators in late 2021 or 2022. Can you either confirm or deny that you were aware of them changing their interest rate risk models possibly in late 2021?
Liquidity risk management project plan that Silicon Valley Bank
I'm not trying to get you in trouble, but I'm asking about specifically about interest rate risk, that they had changed their interest rate models. And I'm just asking you, were you aware, as this article says, can you confirm that the article's right?
In November 15th, 2022, in a supervisory letter which noted the MR.
And I'm sorry, I don't want to be risky. I'm just a yes or no is all I'm looking for, whether you can confirm or deny.
They received a supervisory letter in November 15th, 2022, very clearly indicated.
Okay, so you're saying when the article says late 2021 that that's incorrect?
Were unreliable. In November of 2021, they were notified through supervisory letters that their liquidity risks were models.
I may want to, because I'm asking specifically about their interest rate models, but I don't want to. This says that they changed their models and the regulators were aware that they had changed their interest rate models. I'm not asking when you notified. I'm saying, when did you become aware, and is the article right that that was earlier? We'll follow up on the record because I want to use the rest of the time to talk about some of the New York issues. Superintendent Harris, if I understand right, the stablecoin rules in New York require that stablecoin issues are backed by a reserve of assets that's fully redeemable. Is that right?
Correct.
And am I also right that issuers are not allowed to lend against stablecoins?
That's correct as well.
Does New York regulate how much a stablecoin issuer can keep in uninsured customer deposits?
We do not, although we monitor all of our stablecoin issuers and virtual currency companies to make sure they're holding both commercial accounts and reserve accounts in diversified, well-regulated FDIC-insured banks.
Okay. No, I asked that because Circle had $3.3 billion at SVB. They also had uninsured deposits at Signature Bank that they couldn't access. Coinbase disclosed having $240 million in corporate cash at Signature. We know what happened to USDC and the collapse that. Did New York regulations, either by statute or through the supervisory authority you have, prohibit Signature from loaning against the deposits that they had at from Circle and Coinbase?
No, but I think it's important to realize that Signature did not hold digital assets. They held USD in the commercial account.
Sure, but if it's
And
a
so
stable coin, it's only as good as the reserves. And so what I'm asking is,
Correct. But
if the assertion under New York law is that those assets have to be fully backed,
yeah.
does a dollar deposit does an uninsured dollar deposit at a bank with all this interest rate risk count under New York State rule as fully backed?
Yes, so our stablecoin issuers have to have one-to-one on-chain to off-chain deposits. So if there is a stablecoin outstanding, there has to be a dollar-denominated stablecoin outstanding. There has to be a dollar on deposit with a depository.
Which only matters if the dollar is actually accessible and someone can reach it. Because if they
they're required to be held in USD and cash equivalents, so they can't be held in illiquid assets.
The reason I raise that is because the only reason why the peg has come back for the USDC is because the Fed stepped in and bailed out all the depositors. And I'm very concerned about the exposure that happens if we regulate them. And you guys have done a great job in New York, but if you've approved this and now the Fed has to bail, the only thing that a stable coin does is destabilize our financial system.
Well,
and stable.
And to clarify, USDC is not approved by DFS. It's not available for New York. So we regulate Circle, and Circle is licensed, but as you know, we have product approval, and USDC is not approved for offering in New York.
Last quick question for you. In your written testimony, you said that Signature advised the regulators that its available liquidity on Monday would be bolstered by substantial deposit inflows from a unspecified DFS-regulated virtual currency company. What crypto company were they referring to?
That's confidential supervisory information, so I'd like to maybe be responsive to that in a private setting.
But you know who that
Gentleman's time
We'll
has
follow up,
expired.
Thank you.
And you can follow up in writing on that. With that, the gentleman from Tennessee, the Vice Chair of the Oversight and Investigation Subcommittee, Mr. Rose, is now recognized for 5 minutes.
Thank you, Chairman Huizinga, and thanks to our other chairman and ranking members for holding the hearing, and thanks to the witnesses for being here. Commissioner Hewlett, your report notes that beginning in March 2020, on-site examination functions were performed virtually due to the pandemic. Are the examination functions still performed virtually with staff working from home?
During the period of COVID, the examinations were performed virtually and frequently, and as many of the examinations involved reviewing of documents, we were able to perform our examination review virtually.
And is that still what you're doing today?
We are more in a hybrid state today where some examinations are on-site and some are actually...
Thank you. Do you think it is more effective for examiners to be on-site and in person or working from home?
It really depends upon the bank itself, its size.
Sure, I can answer this. As a former bank board member, I can tell you there is no substitute for in-person on-site. I mean, there's nothing that strikes fear in the hearts of bankers more than that on-site examination. And I would encourage you to move away from that as swiftly as possible, because I do not think you can effectively supervise these banks without that the specter of that on-site examination happening. So thank you for that. Superintendent Harris, you serve on the Financial Stability Oversight Council as a non-voting member, correct?
Yes.
In 2021, the council identified 3 key priorities related to significant vulnerabilities in the financial system: non-bank financial intermediation, climate-related financial risk, and treasury market resilience. And in 2022, the council identified a 4th key priority, risk related to digital assets. Superintendent Harris, which is more concrete and an imminent threat to the current financial system, climate-related financial risk or interest rate risk?
Sir, well, I think there are lots of important factors related to risk, but I also want to clarify, I joined the council at the beginning of this year, January 2023.
Okay. But again, which one do you think is more concrete and maybe I'll stress imminent, maybe to point you to the answer I'm looking for, to the current financial system?
Certainly the interest rate risk that we've seen materialize is
sure, and I think therein lies part of the concern that I would have in the current scenarios that we've seen play out is that I would tell you, I think you took your eyes off the ball. And that it is these long-standing fundamental issues that affect banks that were at play here. And unfortunately, my fear is that regulators were looking too far down the field, too far ahead, and thinking about things that maybe got their minds off of the real inherent risk to banking. Commissioner Hewlett, your report notes that DFPI will require banks to evaluate and account for emerging risks posed by technology-enabled activities such as social media and time withdrawals. Do you attribute the run on SVB more to the use of social media or to its emergency 8K filing on March 8th?
The run on the bank, I feel, is a combination of factors which I've just indicated that created the perfect storm. I cannot assess whether one impacted this run more than others. I think after more time and review, we'll have a better picture. But to be able to say, was it the filing or was it a result that people could withdraw their deposits on digital platforms in less than a second? I can't say whether one or the other was the main factor. I do know that all of them together in the perfect storm.
So in the time remaining, do you think that institutional investors on Wall Street react more to social media or other forms of communication like Bloomberg terminal notifications, SEC filings, client notes, and email chains? And
I haven't
if you will,
done-
please respond. I'm out of time. Thank you, and I yield back.
Yeah, gentlemen's time has expired, and I think you're going to be both doing some writing of responses at these last questions at the tail end of the 5 minutes. So with that, the gentleman from Massachusetts, Mr. Lynch, is now recognized for 5 minutes.
Thank you, Mr. Chairman. And thanks to the ranking member. Ms. Harris, I was curious what happened to banks in New York when Circle broke the buck, when their what is it, their stable coin broke the buck. Yeah, when it depegged. Like we've had situations like that occur with money market funds in the past, and I was just curious what the impact was locally.
Sure. Well, again, I want to be clear that while Circle is licensed and regulated by DFS, USDC is not approved by DFS and therefore not available in New York for New York consumers. The impact on banks from USDC depegging, I think, is maybe less the issue than banks looking to de-risk from banking cryptocurrency customers and their fiat deposits, not their digital asset deposits necessarily.
It has a run effect, in other words.
No, sir. At least in the case of Signature, when we saw the deposits leaving on that Friday afternoon, the deposits that left that were digital asset customer deposits, still in USD, were roughly proportional to digital asset companies' deposits in the deposit base overall. So what we saw was a run across the diverse customer base of Signature Bank.
Okay. Well, what we saw elsewhere, I guess, across the country was, people moving to bigger banks that they felt were safer and that avoided the risk that banks that actually had crypto assets after Silvergate, SVB, Signature, after those problems, we saw migration. I'm worried about that trend because I don't think it's over yet. We see small local community banks, people are nervous about that, and so there are billions and billions of dollars in deposits that are migrating from those small banks that take care of a lot of smaller businesses and individual depositors. That's a huge shift. Do you think that's helpful for the entire banking ecosystem?
No, absolutely not. I think the health and safety of our banking system depends on having this diversity about size of institution.
Yeah. So I'm just wondering, I did read the Fed's guidance. They came up with a rule that, presumptively prohibits banks from taking, crypto deposits or stable coin deposits in many cases. Do you worry that the volatility, because crypto products and stable coins for that matter, stable coins that are not stable, that it invites, when you marry up the banking industry with the crypto industry, you invite in or import in all of that volatility, which is extremely harmful, to the stability of that bank.
Well, I agree, sir. I would say I want to distinguish between banks that hold digital assets themselves and banks that hold USD as part of deposits for virtual asset companies. They both obviously present risks, and banks have to have appropriate risk management protocols in place. DFS has also issued guidance to our DFS and state-regulated banks, making sure they understand that they have to get pre-approval from us before being engaged in any types of virtual asset activity.
Yeah, the thing I'm worried about is the migratory effect. Even if a bank, if a bank is considered to be a crypto bank and FTX happens or something like that, you have an inducement for moving assets, and I'm just and whether or not that is backed or not, we're continuing to see volatility.
Well, I think having the one-to-one backing as we do in New York also helps prevent depegging because consumers know the liquidity is there. It's one of the reasons we've been so eager to continue working with you and your colleagues to put a federal framework in place that looks like what we do in New York.
Yeah, in Massachusetts, it's odd because we have excess deposit insurance above the 250. So it goes to, actually the limit is 10 million, and we still saw people moving their money to bigger banks. And so it continues to be a problem. Anyway, thank you. Mr. Chairman, I yield back.
Gentleman's time has expired. The gentleman from Tennessee, Mr. Ogles, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, ladies, for being here. Ms. Hewlett, you previously stated that the regulator's primary responsibility was to evaluate and highlight deficiencies, and ultimately it was up to the bank to remediate those deficiencies. My question would be, is beyond that, did you have the authority or did your peers have the authority to escalate and essentially force compliance?
We had the authority to escalate and force compliance.
Yes, ma'am. Ms. Harris, same question for you, ma'am.
Yes, we do.
Yes, ma'am. And then is there anything in the regulations that would have prohibited you from escalating the matter at hand with the banks that you were overseeing?
There is nothing in the regulations that would have prohibited us from escalating.
Anything in the rules that would have prohibited escalation?
No.
Same questions?
No.
No on both accounts? Yes, ma'am. Thank you. Ms. Harris, you've said that in reference to climate change, that it's a very data-driven approach to risk mitigation, operational resiliency, and so forth. So I'm curious, if there was a 3.5 degree change in climate temperatures, can, in exact numerical terms, can you quantify how that will affect interest rates?
No, sir.
Yes, ma'am. If there's a 10% reduction in polar ice, can you tell me how that will numerically impact deposits versus, say, interest rate risk?
No, sir.
Yes, ma'am. So I'm curious as to why any bank or any regulator would somehow assert climate change as part of the regulatory process when your role is fiduciary and not activism.
Sir, I agree with you, but what I would say is where we have institutions with concentration, for instance, a set of mortgages in a flood zone, we want them to engage in fair lending processes, but also have proper risk management in place, which doesn't mean not lending in those areas, but being cognizant of concentration risk that may be new in the face of climate change. So instead of thinking of it as activism, we, at least at DFS, approach it as something that should be part of an existing risk management framework, the same way banks should approach any other risks. And one of the examples I use for operational resiliency, for example, is put the generator on the roof, not in the basement.
Yes, ma'am. But still, that has nothing to do with interest rates or deposit structure and, quite frankly, bank governance. More so, again, to my colleague's point, I think there was some priorities given by some of the banks, not all, to climate change, and literally in their minutes of their meetings, they're spending virtually no time on interest rate risk. And so this is problematic, both from a bank management perspective, but also, as you both have stated, you had a responsibility, you had the authority to escalate. That did not occur. And so, and obviously there's plenty of blame to go around, but I think what we have to do in this process is learn from this situation. And I think, and I would caution, we've had some of the agencies come before this body and ask for more authority, but I think we understand clearly that the regulations at hand give you the authority to act. There was nothing prohibiting your ability to act. And so, again, and I have not heard you ladies ask for more authority, so I want to be clear of that fact, but I would caution, don't come before the committee and ask for more authority when the authority that was given wasn't used appropriately. And I want to go to capital requirements, and I think it's been stated, Chairman Jerome and Vice Chair Barr had recently said that banks were well capitalized. At the time, the banks that failed were well capitalized. But I think it's important to understand that deposit structure and interest rate risk was the key factor here, and more money. I don't think there was enough money that we could have poured into the system to save a couple of these banks, right? And in fact, what I would say is, and argue, especially our community banks, is the capital requirements, especially for your smaller community banks, are too high. And if you have a well-managed bank with lower liquidity risk or exposure risk, that should be taken into an account. And so instead of being at 9%, let's not ratchet that up, because what we risk here is we're forcing smaller and mid-sized banks out of the marketplace. And as I come from a working class family. I started my first business when I was very young, and it was the local banker who lent me the first loan, not because I had a great business plan, but because he knew my family. And I just think as you move forward, we must take that into account. Ladies, again, thank you for being here. And Mr. Chairman, I yield back.
Gentleman yields back. With that, we will be going to the Minority Party Ranking Member, Ms. Waters of California, for 5 minutes.
Thank you very much, Mr. Chairman. I'd like to direct my question to Commissioner Hewlett from California. In your report regarding the failure of Silicon Valley Bank, you indicated that your agency is working to better coordinate with federal regulators to develop stronger and more effective systems to promptly remediate deficiencies. And if you could share with us some of the things that you envision could be done working with the feds that would help deal with the crisis such as we have just had before us. So what are you thinking about in ways to work with the Fed to help deal with these deficiencies that lead up to the failure?
Well, first and foremost, we have added, through our existing resources, more people to our examination team to mandate adherence to timelines. We recognize how important our community banks are to our community. And working with our federal partners, we are from the very beginning going to scope out our plan, define our roles as equal partners in recognition of that importance, and work more closely with our federal partners to ensure that those timelines are adhered to. And we believe that we are both going to have to work much more aggressively, effectively, and efficiently in ensuring that the banks in which we provide oversight remediate their deficiencies in a timely manner.
That's very good. Are there steps that the federal regulators can take to better coordinate with state regulators like you? I think that's important that the feds and the state know and understand what each are doing and how to work together. Do you think there's anything in particular that you would like to suggest that could help that relationship strengthen?
And I indicated it's really important at the very beginning of the exam to get the roles straight and also clearly define where we might have to act independently if necessary. I also think that after Silicon Valley banks run, that we all have to consider in evaluating the risk, the impact of social media, the impact of how fast one can withdraw deposits through our digital technology, and we all have to move faster. We cannot get held up in the bureaucracy anymore in this new age.
Thank you very much. As I have listened to the witnesses, there have been any number of deficiencies that have been articulated about here during these hearings. And I just wonder, when we talk about the bank having grown so fast, that was a problem, and that, with that growth and the uninsured, and I don't think the bank provided private insurance, what do you do when you see that a bank is just growing fast? Because, of course, we all support our businesses. We want them to be successful, et cetera. But when you're growing fast, does it mean that you've got to take a look at the underwriting? What can you do when you see that?
It is responsibility of bank management to operate their bank. We won't tell the bank how to invest, but we should act swiftly in identifying the deficiencies, particularly in liquidity and risk management, and hold the bank's feet to the fire to make sure that they're taking that risk seriously.
Well, thank you so very much for your presence here today. I appreciate the information that you have shared with us, and I yield back the balance of my time.
The ranking member yields back. With that, the gentleman from South Carolina, Mr. Timmons, is recognized for 5 minutes.
Thank you, Mr. Chairman. Commissioner Hewlett, your report is notably silent on any examination activity prior to 2020, yet GAO's report makes clear that, in fact, there were concerns related to SVB's management practices that were outstanding going back to 2018. Why did you not include those in your report?
Prior to that date, the management practices were primarily concerned with IT, audits, but it wasn't until we get into 2022 that we get into the areas of real liquidity risk And at that point in time, we felt that that was the most important. We did note that there were management deficiencies prior to that time, again, in terms of our review of their IT practices and some of the data privacy. But where we found the most significant deficiencies is when they were evaluated for management, governance, liquidity, and capital risk.
Thank you for that. Can you explain how supervision by DFPI was conducted jointly with the Federal Reserve when a bank was in the Fed's regional banking organization's portfolio?
We will assign dedicated examiners. In this case, there were 2 dedicated examiners. We meet with our regional federal partners, and we will become involved in the scoping and the planning of the exam, segmenting the different areas. And in this particular matter, we took the areas of governance and management from an enterprise perspective, asset review, and IT review, whereas the more enhanced reviews as they related to capital and liquidity risks were taken primarily by our federal partners who did the review. But we are in collaboration with our regional federal partners when it relates to larger banks. And when we say larger banks, banks that are over 10 billion in assets. And when the bank reaches a point where it's over 100 billion in assets, it even goes to another level of review under the Large Foreign Bank Organization Program.
Thank you. Your report states that from late 2021 throughout 2022, a dedicated examiner in charge highlighted the need for additional resources to review SVB materials. Even the DFPI financial institution managers elevated the need to divert resources to SVB, yet the discussions did not result in assigning additional staff to the exam team. In August of 2022, the examiner again reported the need for additional resources. According to your report, no additional resources were scheduled to be added until after the bank failed. How many times typically is a resource request raised with respect to an examination team before it is addressed?
And that is one of the reasons why we have added from our existing staff a more enhanced team. We've also added another level of supervisory review so that when you see areas that would put a bank at a high risk, particularly a large bank with this level of assets, that it is addressed immediately.
And that was done after SVB failed?
That is correct.
Okay, and prior to the bank failure, did a similar staffing issue occur at any of the other 8 large banks that DFPI oversees, or was it only with SVB that had the resource request issue?
SVB was an outlier. It grew at a very, very fast pace. It had assets over 200 billion. And as I previously indicated, our average size for our community banks is 4 billion, and about half of ours, 43, are 1 billion in assets.
Thank you. Mr. Chairman, I yield back.
Gentleman yields back. With that, the gentleman from Illinois, Mr. Foster, is recognized for 5 minutes.
Thank you, Mr. Chair. Superintendent Harris, in the Signature Bank failure, it seems like the most significant factors in its demise was not so much the concentration of crypto client deposits, but a lack of pledgeable assets that were immediately available for liquidity support. And so, you know, and as the speed of runs increase with technology, it's going to be necessary to have even better real-time liquidity information available to regulators. I was also surprised to see in your testimony that at Signature, during the days immediately before the failure, there was a lot of real-time uncertainty about the net and pending deposits and withdrawals. So why isn't that real-time information? What are the limiting factors that cause you not to have real-time?
I think the limiting factor in this case was the inability of management to produce the data that's very basic and that any set of bank managers, board members should be able to produce at a moment's notice. So as we've noted in our report and in my testimony, the numbers that all regulators were getting with the bank were inconsistent and unreliable, and it's just unacceptable.
But did the bank management have some sort of real-time dashboard where they can just sit there and look and see how deposits are flowing in and out?
I would say they should, or at the very least have the ability to assess the value of collateral that they have, the value of the securities they have on their balance sheet.
Yeah, well, it's a separate thing. I was talking, it seems like deposits might be a simpler case. Are there things that limit, what are the items that limit having real-time deposit and withdrawal information?
I think mostly settlement times and the variety of payment systems that a bank might use, but I think certainly in the case of Signature, they were too slow and unrealistic about their deposit and withdrawal inflows and outflows, respectively.
Okay, and do you get access when they get in trouble? Do you get access to whatever dashboards they have?
We requested data from them many times throughout that weekend, and often we were faced with hours-long delay in those productions and then swiftly changing estimates within minutes.
Well, it seems like they should just have given you the password to an account where you get to see whatever dashboard they're looking at. And now to the issue of collateral, are there mechanisms, for example, what's your view of the home loan bank system and how rapidly it was able to respond? Are there deficiencies there? Are there other ways that we could speed up qualifying collateral, or was this just mechanisms exist and weren't used ahead of time?
I think the mechanisms for evaluating pledging collateral probably bear some modernization. It's one of the reasons why in our report we suggested operational stress testing, as we've termed it, almost tabletop exercises that institutions can engage in with their regulators to be able to run these drills real time so that in the event of a real life crisis, they're better equipped to provide data, pledge collateral, and take the steps that they need to get liquidity.
Mm-hmm. And are there any significant third parties who could step in that have the same level of technological connection, as, for example, the Federal Reserve was, I guess the main backstop when this sort of thing happened?
Yeah, well, I think the Federal Reserve and the other regulators, DFS, FDIC, worked very quickly and very well to help overcome some of those operational challenges. For instance, working with the Federal Home Loan Bank and the New York Fed to make sure that the Federal Home Loan Bank could subordinate its interest in collateral to the Fed in order to get faster liquidity for the bank when it couldn't get that liquidity as fast as we would have liked from the discount window.
So what sort of risk were they taking on when they subordinated the interest? I'm a physicist, not a banker. So
Well, I think probably the same amount of risk whenever you subordinate your interest in some sort of debt. When you lower yourself in the priority stack, you enhance the risk because you're a lower priority debtor. But I think that's the case with any type of debt.
So this would be the home loan bank going belly up that would cause them trouble, which presumably shouldn't happen, or we would be forced to do something about it if it did. So there wasn't a major risk there.
No, I think that's
are there, during the crisis 12 years ago, you had instances where Warren Buffett stepped in and said, I'm going to help out. And is there a merit to have, a group of accredited people with the right technology who can step in and provide liquidity support, in emergency situations? Is there a need for something like that, to have something besides the Federal Reserve, the liquidity provider of last support?
I think in the face of what we're learning about the speed of runs, the impact of social media, digital banking, we should be considering all kinds of alternatives to make sure our banking system is safe and sound.
Yeah. Well, and it has to respond on the same time scale as the internet.
Yeah, and we want to make sure that it's subject to the same safeguards as well.
Great. Thanks much. Yield back.
Gentleman's time has expired. The gentleman from Wisconsin, Mr. Fitzgerald, is recognized.
Thank you, Mr. Chair. On November 11, 2022, Wall Street Journal article explained at length interest rate risks presented to the banking system by the Fed's inflation-fighting rapid increases in interest rates. Silicon Valley Bank was mentioned as a particular case with, as of September 30th of 2022, a market value of its held to maturity bonds just slightly above the value of its total equity. So clearly the regulators should have been becoming aware of risks, if they weren't already, surrounding Silicon Valley Bank. Commissioner Hewlett, if the uninsured depositors had not forced the bank to close, how much longer do you think the regulators would have allowed Silicon Valley to remain open without intervening?
An MOU was in the process of being initiated. However, the bank run occurred before the MOU was initiated. So I believe it would have depended upon how the bank responded to the MOU. If they did not respond to the MOU or any subsequent orders, we would have had to take it to another level in the form of a consent decree and a cease and desist. So it is hard for me to say, sitting here today, how long, because it would have depended upon their response.
And as you're well aware, there's state chartered banks and then there's federally chartered banks. And so I'm just curious, because something that has not come up much is the involvement of the state of California and your office. And then Gavin Newsom, the governor, talked about his interactions with both the White House and with Treasury. Were you part of those conversations, or how did those evolve as it was discovered that the bank could be in trouble?
I was not involved in any systemic risk discussions, nor did I discuss anything in regards to systemic risk with the governor.
Very good. And when the banks, when they see rates move up, such as they did, and the realized losses on the long-dated securities were in place, did you anticipate you'd have other regional banks in California that could actually see deposits start to be pulled?
At the point that the Silicon Valley Bank's run began, we really began enhanced monitoring of all of our community banks, and we received hourly reports, and we monitored the depositors' outflows on an hourly basis. Because once that fear starts, it's easy for it to spread regardless of how well any bank management is running the bank, regardless of how much capital. The fear spreads. And so we were monitoring very closely to try to contain it.
So in your role as commissioner, what do you feel was your responsibility, or did you have a responsibility as this started to develop, I guess is my question?
We were focused as a result of the run, on all of our other banks within California. And in that focus, we contacted each and every one of our banks that we thought might be at risk from the fear and the contagion, to give them as much support as possible.
Okay.
Fortunately, we were able to resolve a number of the issues, and that fear and that contagion did not spread throughout our financial system.
Were you in contact with the FDIC throughout this process as well?
I was only in contact with the FDIC in terms of taking possession of the bank, liquidating it, and then turning it over to the FDIC in receivership. From that point on, I was not in contact with the FDIC as to what would be done in terms of the uninsured depositors or whatever negotiations may or may not have been taking place in terms of finding
Gentleman's
a
time
bank
has
that would
expired.
acquire.
Very good. Thank you. I yield back.
Has expired. With that, the gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you. Thank you to our witnesses for joining us today. Obviously, the collapse of Silicon Valley Bank and Signature Bank have had significant implications for both our financial system as well as our regulatory framework. So it's good to have state regulators before this committee to testify and discuss the reports regarding New York and California, Signature Bank and SVB respectively. The report from California regulators on the failure of SVB identified several areas of concern about SVB's governance and risk management. In May of last year, the regulators eventually downgraded the management component of SVB's 2021 CAMELS rating and the governance and controls rating at the holding company. Commissioner Hewlett, the report notes that at the time that SVB's management rating was downgraded, the regulators did not perceive any imminent threats to the bank. Can you explain why this was the case?
At the first downgrading of that bank, the deficiencies that were noted were primarily in IT. On the second downgrade of the bank, when they were doing the liquidity reviews, and it had been downgraded further to a 3, less than satisfactory, the regulators felt they had more time. They did not anticipate the type of run that occurred in this bank in which $42 billion went out in one day. In hindsight, regulators should have been much more aggressive and made the bank management adhere to the timelines.
Thank you. And to follow up, Commissioner, the report also mentioned that historically, bank examiners have not viewed a high ratio of uninsured deposits to total deposits as a significant risk factor. But you recognize that a high level of uninsured deposits at SVB contributed to the run on SVB. So do you think regulators should commit to increasing their focus on banks with high ratios of uninsured deposits?
I do, and that's exactly what we're doing right now. As a result of this, in hindsight, we have enhanced our team, and one of the areas that we are taking into consideration in our early warning modules is those banks that have a high percentage of uninsured depositors in one particular area. But I would say that this really was an outlier in Silicon Valley Bank. 93% of uninsured depositors is highly unusual and is not what you see in your average community banks.
Very good. So we're agreed regulators should take steps to mitigate risks that can arise from having such a large amount of uninsured deposits. And, you know, we really do want to learn the lessons from the turmoil of these last few months and reform these practices to ensure this does not happen again. I'm of the opinion, as are many of my colleagues on this side, that reinstating the Dodd-Frank regulatory requirements on mid-sized banks that were rolled back in 2018 by Republicans are really critical. We can learn from this on the state level as well. So I urge my colleagues to support these measures being reinstated. Again, thank you for coming before the committee, and I yield.
Gentlewoman yields. The gentlewoman from California, Ms. Kim, is now recognized for 5 minutes.
Thank you, Chairman. High inflation, not seen over 4 decades, has led to real-life consequences in the form of failed banks and over $400 billion in assets wiped out from 2 of the largest banks that is headquartered in California. And in total, we've seen 3 banks failing under the watch of California state regulator. And more recently, First Republic is the 2nd largest bank in the United States, just behind, Washington Mutual. So with that, Commissioner Hewlett, why do you think California financial institutions are bearing the brunt of the current distress in the banking industry?
In terms of First Silicon Valley Bank, as I previously stated, I don't think there was just one factor. There were numerous factors that created the perfect storm. Once the run started as a result of deficiencies in governance and management, deficiencies in taking into consideration risk management in the areas of capital risk and liquidity risk. Once you see the impact of social media and digital platforms and how quickly one can withdraw their money from the bank, in addition to regulators not acting in a timely manner, all of that started that run in Silicon Valley Bank. And once that fear starts, it spreads.
So it's fear-driven, social media-driven, internet-driven. You think that had to do with that?
And then it will spread to
Well,
other banks, regardless of what their
Sure.
management.
Let me reclaim my time so I can ask you other questions. Can you explain how supervision by DFPI was conducted jointly with the Federal Reserve when a bank was in the Fed's regional banking organization's portfolio?
Generally, when we have banks that are over $10 billion, we will, and particularly in this case where you have a very large bank that may be over 50 billion, 100 billion, or 200 billion, we will examine that bank in accordance with whoever is the primary regulator. The primary regulator in this case was the Federal Reserve Bank. We meet together at the regional level to determine the different portions of the exam and who is going to do which portions of the exam. And some portions of the exam we will do together. In this case, you had an added factor because it had grown so rapidly that it fell under the category of a large foreign bank organization. So in addition to working with the regional, it also went up to the examiners in DC who were highly trained in examining.
Thank you, Commissioner
banks.
Hewlett. I want to talk about the report, so let me stop you there and then talk about the report. In the beginning of that, you state that there was divided oversight over SVB, such that the Federal Reserve Board in San Francisco assumed the lead role for supervisory activities of SVB. Yet later on that report, it states that SVB was examined jointly by DFPI and FRBSF. So the wording in the word makes it appear as though the DFPI is the only involved in a subset of oversight activities related to banks within its jurisdiction. So is it true that DFPI relies on supervision by examiners from the Federal Reserve for certain oversight activities of state chartered banks?
Well, first, we examined different sections separately. DFPI was very much taking the lead on the governance and management of that bank from an enterprise perspective. They took the lead on the IT examination of that bank. They took the lead on the asset examination of the bank. However, when it came to examination under the large foreign bank organization program, in that case, that is when a more experienced team of the Federal Reserve
How does
program.
DFPI conduct itself as a primary state regulator over the bank if it's only involved in a portion of the supervision?
And this is one of the reasons why we have added an enhanced team on.
Sorry to interrupt, but that time has expired, and
Thank you.
we can get you a written answer on that. With that, excuse me, the gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you, Mr. Chair. Superintendent Harris, do you think what happened with Silicon Valley Bank led to the other failures?
Yes, I do.
Why?
I think it was a contagion effect between social media, the speed of being able to withdraw, the association, however valid, between some of the banks led to a contagion effect.
So Director Harris, Becker was here. Did you both listen to the testimony before?
I did.
You did?
In part, yes.
Yeah, Director Harris, Superintendent Harris, one of the things interesting is Becker kept talking about social media. I can understand the other two banks, right? But he kept emphasizing that was a major factor in some of the mismanagement. And somehow, poof, it's because social media, and that's why they were in there. I'm going to get to you, Commissioner. I know, I see you. But do you believe, I mean, how much of that really was weighed? I mean, I can ask the Commissioner, but he basically is leaning on this claim that social media was the reason.
I think failure of bank management to have adequate liquidity risk management is really at fault.
Yeah. So Commissioner, thank you so much for being here. I know you're getting a lot of, but I mean, I think Silicon Valley Bank exposed a lot of, I think, areas for us as members of Congress to work on. You know, I don't know if you listen to the testimony of Becker, the former CEO beforehand. Did you?
I did not listen. I heard about some portions of it.
Sure. I mean, do you, one of the things that I kept hearing about, because I know if I'm getting do you send it via email? How do you guys send the correspondence to Silicon Valley? Was the subject matter like matters requiring attention in the subject matter? I'm being serious, like what was being sent to them? Email.
They received 7 supervisory letters detailing their deficiencies. There was 31 MRAs and MIRAs, matters requiring immediate attention. So they were on notice as to their deficiencies.
So I would love to send you, I think the committee should send her a transcript of the whole testimony because, you know, what went through this timeline, as you can see, and you know, like I think in January, they started changing their trading plan. Is that what they call it, trading plan? Were you aware of that when in January that they started to implement what they call trading plan change? Were you aware of that, Commissioner?
We became aware from the state perspective afterwards, and we highlighted the risk.
So January 26th, they do that. They implement a change to the corporate trading plan. If you listen to testimony, he says it's completely unrelated. It's like, oops, we failed, but this is after the bonuses, after compensation, which they claim was really already set and scheduled beforehand. Do you believe that?
The matter is under investigation right now, and I think it will come to light soon.
Well, okay. Well, you're going to investigate the role of compensation incentives in your report, ma'am?
We have other programs under DFPI, and I can't confirm or deny other investigations that are ongoing.
Okay. Do you think that incentive compensation plans have contributed to the poor risk management and sufficient response to warnings demonstrated by senior employees at Silicon Valley Bank?
I do think it did contribute. I think there was more of a focus on earnings and gain than there was on risk management.
Yeah, I mean, through the chair, I really think there should be an investigation in whether or not Mr. Becker was fully truthful with us as members of Congress in this committee. It was very telling of how little he claimed to know and that others knew, and that this was just by coincidence, that this timeline, if you look at it, any layperson could look at this and see this was set up in a way, again, for him to make millions and everybody to walk away while our financial system in our country you know, is basically hurt and harmed, as we can see with the 2 other banks that failed. I know there's nothing they can do, but I really would love for you all to respond directly to some of the testimony by Becker. I think it's very telling how little he claims to know, and I really don't believe he didn't know all of what was going down.
Gentlelady's time has expired. The gentleman from Florida, Mr. Donalds, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Ms. Harris, Ms. Hewlett, thanks so much for being here. Ms. Hewlett, I'm going to start with you. So everything I've been able to surmise from today's hearing is that there was a dual regulator for SVB. It was part your department, part the Federal Reserve Bank of San Francisco. At what point did you or the SF Fed realize you were having structural balance sheet liquidity issues with SVB?
We recognize that on March 9th, when SVB had a negative cash balance of $958 million, they were insolvent.
Ms. Hewlett, and I want to go back because I think everybody understands the insolvency aspects when it actually occurred. But at what point did the supervisors of the bank, the actual people on the ground, did they start to see that there were some potential issues with the structure of the balance sheet? When did that start occurring? Because the bank had been cited at least 13 times up before its failure. So, like, give me that process. Like, when were they notified?
They were notified numerous times.
And what was the response?
But definitely in 2022. However, I don't, and I can't speculate as to what was in their mind, but they were given numerous supervisory letters, and definitely when that run started to happen and depositors started to withdraw their money out of the bank.
Ms. Hewlett, once the run starts, the game's over. So
right.
The run, we understand that piece. What I'm trying to ascertain is they were cited numerous times. And by the way, I was in commercial banking. That's where I started my career. I've dealt with regulators. They were cited numerous times. What was the response from Silicon Valley Bank when they were being cited? What was their response? And actually, what was the tone from your agency or from the SF Fed in response to Silicon Valley Bank's lack of curing the issues that were coming up in their audits, in their reviews?
Liquidity risks were noted in 2021.
I know, but...
And remediation was not taken seriously by bank management.
Okay.
Regulators did not move aggressively in
Why didn't the regulators move aggressively enough?
I do believe that regulators at the time worked more in a culture, particularly on the state banking side, to give a bank time to remediate.
Well, Ms. Hewlett, and I got 2 minutes left, so I understand what you're saying. From our perspective, we have various members who want to talk about new regulations and different things like that. But what it appears to me as is that SVB was too cozy with the regulators. There's a lot of fraternization going on, and nobody put the hammer down when they should have at the time when they noticed the structural liquidity issues on the balance sheet. Ms. Harris, I'm gonna come to you. I know we talked a lot of SVB in this hearing. In New York, Signature Bank, tell me, were there any supervisory findings that were given to Signature Bank prior to their collapse?
Yes, numerous.
And what was the response from Signature Bank?
Inadequate remediation.
What was the response from the regulators?
In some cases, downgrades, in some cases, additional supervisory recommendations, but nothing as strong as there should have been.
Nothing is strong. Okay, so I mean, look, it seems like we're in the same place here. And by the way, I'm not a fan of Dodd-Frank, never have been. As somebody who worked in the industry and understood what happened during the financial collapse, Dodd-Frank is an albatross of a regulatory scheme. Doesn't really make a lot of sense. And under Dodd-Frank's framework, we still have these banking issues. It may not be the large, massive banks, but regional banks play a significant role in our financial system. I guess so I would ask both of you, as being representatives of your regulatory agencies, what's going to change in terms of holding bank management to sound banking principles if they can just look at your letter and ignore you?
Sir, I'll take the first stab. I think it's a good point. We are working to escalate things quickly and under my time in my 19 months at DFS to take swifter and more severe action where necessary.
Do you think, and final question, Ms. Harris, I'm going to ask you, do you think it's appropriate at this point for the Federal Reserve to actually be in charge of supervisory oversight of banks?
Yes.
Do you think they're good at their job?
I think all regulators are working on recommendations to improve oversight.
All right, I yield back.
Gentlemen's time has expired, and I would like to thank Supervisor Harris and Commissioner Hewlett for your time today. This has been helpful and gives us a additional picture into what has been going on. Without objection, all members will have 5 legislative days within which to submit additional written questions to these witnesses. You write those questions to the chair, and we will forward those on to the witnesses for their response. I would ask each of you to respond as promptly as you are able, and there were a number of instances where your answer was either truncated or the question was asked but not able to get an answer here earlier today. So again, appreciate this as we look to make sure that we have safety and soundness of our financial institutions here in the United States, and make sure that the regulators that are supposed to be holding them accountable are held accountable by us. And that is the goal of today's hearing. So with that, the hearing is adjourned.